Please like, share, and subscribe. Wishing you happiness and good luck every day.
You ever see a stock chart that just screams sell? You know, the kind that looks like it's about to fall off a cliff, only to watch it turn around and rocket higher? Well, today we're going to dive into a really fascinating pattern from the work of Thomas Bulkowski, where what looks like a total failure might actually be the real opportunity. Let's get into it. So, to really get a handle on any chart pattern, you got to understand what you're even looking at. I want you to think of a stock chart less like a bunch of random squiggles and more like footprints. Yeah, footprints. They're the traces left behind by thousands of traders, all making decisions. But what if some of those footprints are actually designed to lead you astray? The expert who did all this research is Thomas Bulkowski, and this quote from him just nails it. The idea is that these patterns on a chart aren't just the moves of some smart money hedge fund. No, they're a map of raw human psychology. You're seeing hope, fear, and greed all playing out right there on the screen.
Now, here's what makes this whole thing so compelling. The stuff we're about to get into isn't based on some gut feeling or a few cherry-picked examples. It comes from a massive study of over 43,000 different patterns. This is hardcore, data-driven analysis.
Okay, so spotting the footprints is one thing, right? But the real trick, the place where the money's made, is in knowing what happens next, and that's exactly what Bukowski's work focuses on, moving past just seeing a shape on a chart to actually understanding what it's likely to do. All right, let's get to the main event. We're going to dissect one of the most specific and, frankly, one of the most misunderstood patterns that Bukowski uncovered. It's called the Big M. At its heart, the Big Mem is pretty simple. It looks exactly like it sounds, a big capital M drawn out by the stock price. Now, you might have heard of a double top, and this is basically a cousin to that, but with a few very important details that make it unique. Okay, so let's break this thing down using the diagram. You can see it all starts with this really fast, almost straight line run up to that first peak. That's crucial. Then the price pulls back, forming a little valley. You can see it labeled as B1, before rallying back up to a second peak, C1, right around the same price as the first one.
So how do you spot one of these in the wild? It's really just a three-step process. First, you've got to find that steep, sharp rise. It can't be a slow, gentle slope. Second, you identify those two distinct peaks at roughly the same level. And third, and this is the important part, the pattern isn't officially on until the price breaks down and actually closes below that valley in the middle. That's the signal.
Now, according to all the trading textbooks, once you see that confirmation, that breakdown below the valley, you should be expecting one thing and one thing only: a serious drop. Yeah, in the world of technical analysis, this is what's known as a classic reversal pattern. It's the chart basically screaming that the buyers have run out of gas, and the sellers, what we call the bears, have wrestled control away and are about to push the price down. It's a textbook signal to sell your stock or even short it. And the data, at first glance, totally backs this up. Bulkowski's research found that, on average, after a Big Mac is confirmed, the stock falls by a pretty hefty 17%. That is not a small move. But wait, it gets even more bearish. In a whopping 60% of cases, the stock doesn't just dip a bit. It falls all the way back to where that whole steep run-up started, essentially wiping out the entire gain. So this looks like an open and shut case, right? A total slam dunk for the bears? Ah, but this is where our story gets really, really interesting. Because what happens when that plunge that everyone is expecting, well, what if it just doesn't happen? Based on everything we've just seen, the answer seems completely obvious. You see the Big M, you see it break down, you sell. It seems like a super reliable, high-probability trade. But is it? Okay, now check this out. While the pattern works like it's supposed to about 2/3 of the time, a full 1/3 of the time, it busts. Let that sink in. 1 out of every 3 of these seemingly perfect sell signals completely and utterly fails. That is a huge failure rate. So what exactly do we mean by a bust? It's very specific. It means the pattern breaks down just like it's supposed to, but the drop is really shallow, less than 10%. And then, instead of continuing its slide, it suddenly whips back around, rallies all the way back up, and closes above the highest peak of the M. It's a total head fake. And here it is. This is the punchline. When a big M pattern busts, it doesn't just fizzle out. It becomes an incredible launch pad for a powerful move up. The average rise after one of these busts is a staggering 47%. The failure of the pattern is a far more powerful signal than the pattern itself ever was.
This is a complete game changer. It means the real, juicy opportunity isn't in trading the pattern that everybody sees coming. It's in trading its failure. So how would you actually do that? Well, let's put these two approaches side by side. The obvious trade, the one most people make, is to see that breakdown and just hit the sell button, hoping for that 17% drop. But the busted pattern play is the complete opposite. You see the breakdown and you wait. You wait for it to fail, you watch for the reversal, and then you buy as it breaks out above the old high, looking for that monster 47% rally. And this slide right here is basically the playbook, laid out for you in 5 simple steps. You identify the pattern, you watch for the downward breakout that sucks everybody else in, you see if that drop runs out of steam, and if it reverses and takes out that old high, that's your signal to go against the crowd and buy. So I think the key takeaway from this whole deep dive is a really powerful question. It kind of forces us to look at the market a little differently. What if the most profitable signals aren't the ones that work perfectly every time, but the ones that fail spectacularly, trapping the crowd on the completely wrong side of the trade? It's a fascinating thought to end on.
All right, let's get right into it. Today, we're talking about a really specific and honestly a pretty powerful chart pattern called the Big M. We're going to break down what it is, what it signals, and, here's the interesting part, what it means when it doesn't work.
And no, we're not grabbing lunch. You know, when you hear Big M, you might think fast food, but in the world of trading, it's a special twist on the classic double top. It's got a few unique quirks that really set it apart and make it worth watching.
So how does this thing actually take shape on a chart? Let's walk through it step by step, because what you're really seeing is a story. It's this tug of war between the bulls and the bears, all playing out in the shape of one big letter.
Okay, so here's the whole playbook laid out for us. You can see it all right here. That big initial climb, the 2 distinct peaks that form the M, and then that critical drop-off point. This is the classic journey we're about to dissect.
Every Big M starts with what's called the launch, and this isn't some slow, lazy climb. The source material describes it as a straight-line affair. Basically, the bulls just take complete control and the price rockets upwards, fast and steep.
But, you know, that kind of explosive move can't go on forever. Eventually, the buying pressure runs out of gas, and the price hits a ceiling. This right here forms the first peak of our M. It's the first real hint that sellers are starting to wake up.
After hitting that wall at peak 1, the price pulls back. The bears finally get a word in, pushing the stock down for a bit. This dip creates that valley right in the middle of the M, and trust me, that low point is super important later on.
But the bulls aren't ready to give up just yet. They regroup and try to make another run for it, pushing the price back up. But they falter. The rally stalls out right around the same level as that first peak. That failure to make a new high gives us our second peak and finishes the M shape. Now here is the absolute most crucial part. The pattern isn't officially confirmed until the price actually closes below the bottom of that valley we just talked about. That move is the breakout. It's the signal that the sellers have won and, well, timber.
So, a confirmed breakout is the trigger. But what does that actually mean for the stock? What happens next? Let's look at the numbers because the data tells a pretty clear story about the aftermath of a successful Big M.
According to the research, which analyzed over 1,300 of these patterns, the average price drop after a confirmed breakout is 17%. I mean, that is a really significant move down, and it shows you just how much power this bearish signal can pack.
And it often doesn't stop there. In a full 60% of cases, the price doesn't just dip a little bit, it keeps falling all the way back down to, or sometimes even below, the price where that whole crazy run-up began in the first place.
Okay. But here's where things get really, really interesting. Patterns don't always do what the textbook says they're supposed to. And with the Big M, a failure isn't just a nothing burger. It can actually be a massive signal in the exact opposite direction. So we've seen what happens when it works perfectly for the bears. But what happens when you get that breakout and then nothing? The price just refuses to tank. This is where the story takes a really fascinating plot twist.
This is exactly what a busted pattern looks like. The price breaks down, but it's a total fakeout. The drop is tiny, less than 10%, And then, whoosh, it reverses and rockets back up, closing above the top of the M. The trap was set, all right, but it was the sellers who got caught.
And don't think this is some rare once-in-a-lifetime event. The data shows that, especially in a bull market, 1 out of every 3 big M patterns will bust, a 33% failure rate. That's a huge piece of the puzzle you just can't afford to ignore.
And now for the big payoff. This is why you watch for the failures. When this pattern busts, the reward is, and I'm quoting here, mouth-watering. A single busted big M leads to an average price rise of 47%. That failed bearish signal flips and becomes an insanely powerful bullish one.
So now we know what it is and what it's capable of, both good and bad. But how do you actually find one on a chart? Let's boil it all down into a simple, actionable checklist you can use to identify a true Big M pattern. This right here is the absolute key difference. Look at the Big M on the left. See how sharp and steep that initial run-up is? It's almost a straight line. Now compare that to a more common double top on the right, which has a much slower, more rounded feel to it. That initial launch is what screams Big M.
So here you go, your 4-point checklist. First, find that steep, straight line rise. Second, check the height. You want to see tall sides on your M. Third, spot the 2 peaks that level out near the same price. And finally, number 4, you have to wait for that confirmation, a close below the valley.
And that really leaves us with something to think about. When a chart pattern fails, it's so easy to just write it off as noise. But as we've just seen with the Big M, sometimes the most powerful signal isn't the pattern succeeding, but the pattern breaking. So is it really a failure, or is it just a different, maybe even bigger opportunity? Thanks for tuning in.
Have you ever been staring at a stock chart and seen a shape that looks just like a giant letter W? Well, it turns out you might be looking at a really powerful signal. Trading expert Thomas Bulkowski calls it the Big W. And today, we are going to decode exactly what it is and why it's got such impressive stats behind it. Let's get right into it.
Okay, let's just start with the number that makes everybody lean in a little closer. According to Bulkowski's research, which looked at hundreds and hundreds of these trades, a confirmed Big W pattern leads to an average price jump of 45%. Now that's a huge number, right? But the average never tells the whole story. The real secret, the real money, is in the details.
And that really gets to the heart of what we're talking about today. There's a quote from the source material that says it all. The details tell the truth. That 45% is the headline, for sure. But actually trading this thing successfully means you have to know which little details separate the big winners from the painful failures.
So what exactly is a Big W? Well, at its core, it's a bullish reversal pattern. That just means it signals a potential shift from a downtrend to an uptrend. You're looking for 2 clear valleys or bottoms that form at basically the same price. But the most important part, the thing that makes it a Big W, is what happens before it, a really tall, sharp, and significant drop in price.
So here's how we're going to break this all down. We'll start with the anatomy of the pattern, what to look for. Then we'll get into the numbers, the stats behind how it performs. From there, we'll build a simple trader's playbook to help you spot the best setups. And we'll wrap up with what is easily the most important part, how you manage the risk.
All right, first things first, let's dissect the anatomy of a valid Big W. You can think of this as our official checklist. See, not every W shape you spot on a chart is the real deal, and, getting this part right is absolutely crucial.
This little diagram here is like our treasure map. The launch price, that's where the whole thing starts, right at the top of that steep drop. Then you get the 2 valleys that form the W. The breakout is our green light. That's when the price punches through and closes above that middle peak. And see that little dip after the breakout? That's called a throwback. It's super common, and we'll talk more about that in a minute.
Okay, so let's run through that 5-point checklist. Number 1, it all starts from a high launch price. Think of it as the edge of a cliff. 2, the drop from that cliff has to be steep and fast, almost a straight line down. 3, and this is a key measurement, the height of that fall needs to be at least 1.5 to 2 times the height of the little peak in the middle of the W. 4, you need 2 distinct bottoms that are pretty close in price. And 5, and this is non-negotiable, the pattern is only real, it's only confirmed after the price closes above that center peak. That's your entry signal.
And here it is in the wild. This is a chart of Armstrong World Industries, and it's just a picture-perfect example. You can see it all. Point A is our launch price. Then you get that huge cliff-like drop. You have the two distinct bottoms at B and D. The breakout happens right above that center peak at C. This is exactly what you're looking for.
All right, so now we know what to look for. Let's get into the fun part, the numbers. What does the data actually say about what happens after you find one of these and get a valid breakout?
Remember that throwback I mentioned? Well, it happens a lot. The data shows that in 62% of cases after that initial pop, the price will take a little breather and dip back down to test that breakout level. Now, I know that can feel pretty scary when you're in a trade, but it's actually totally normal.
And here's why you shouldn't panic. The key thing to know is that a throwback is usually not a sign of failure. In fact, after that little retest is over, the stock continues to push higher an incredible 79% of the time. It's often just shaking out the weak hands before the real move starts.
But what about when things go wrong? Well, the pattern does bust about 16% of the time. Now, a bust is when the stock fails to get going. It doesn't rise at least 10%, and instead it rolls over and drops below the bottom of the W. So yes, the minority of cases, but it's a real risk we have to plan for.
And that risk is no joke. When a big W does bust, the average drop below the pattern's low is a painful 22%. This right here, this number is exactly why you have to know your exit plan before you ever get into the trade. Okay, so this brings us to the most valuable part of this whole thing, the playbook. We're going to use Bulkowski's data to figure out how to separate the A-plus setups from the ones that are likely to get you in trouble. This is where those details really do tell the truth.
First up, what should we avoid? The research points out two setups that the author literally calls bad. On the left, you've got a W that forms after a really weak, slow, grinding uptrend. And on the right, you see one that forms after just a tiny little drop. In both of these cases, there's just not enough pent-up energy to fuel a big move higher.
So now for the good stuff. These are the two high-probability setups you really want to be hunting for. On the left is the bottom fishing play. This is when the big W shows up after a huge, massive price collapse. On the right, we have the momentum play. This happens when a really sharp, fast uptrend gets interrupted by the W pattern before it takes off again. Let's dig into the numbers for that bottom fishing setup. Just look at the difference between the two columns. It's night and day. The average gain is way higher when the pattern comes after a big drop of more than 30%. And what's really interesting is that it doesn't really matter if that drop was fast or slow. The key factor is the size of the drop. Now let's look at the momentum play. For this one, both the size and the speed of the move matter. Check out that bottom left corner. That's the sweet spot. A massive 58% average gain happens when you get a big rise of over 46% that happens in a short period of time. That's a classic sign of powerful momentum that's ready to keep going. So let's just boil this all down into a super simple playbook. It's a go if you see a big W that comes after either a huge drop of over 30% or after a fast, steep rise. And it's a no-go, a pattern to avoid if it follows a small, slow rise or just a shallow little dip. The context of what came before the W is everything. Okay, we've found the pattern. We've picked a high-probability setup. Now we come to the final, and I mean the most critical, piece of this entire process, managing our risk. How do we make sure we protect our capital if we're wrong? Well, the data on this couldn't be any clearer. Look at this. If you put your stop loss somewhere inside the pattern, between the bottom and the breakout point, there's a staggering 73% chance you're going to get stopped out by just normal price wiggles, even if the pattern eventually works. But compare that to putting your stop just below the pattern's low. There, it only gets hit 2% of the time. So the research hands us a very clear, data-driven rule on a silver platter. Place your stop loss order just a penny or so below the absolute lowest point of the entire big W formation. This gives the trade room to breathe, it helps you avoid getting shaken out, but it still gives you a clear line in the sand for your maximum risk. Okay, so let's wrap this all up. What are the key takeaways? Number one, the big W can lead to a huge 45% average gain, but the context of how it formed is everything. Two, always verify the full anatomy. You need that tall left side, that steep fall, and a valid breakout. Three, focus on the A-plus setups, the ones that come after a big drop or a fast rise. And finally, and most importantly, always protect your capital by placing your stop below the pattern's lowest point. And I'll just leave you with this final thought to chew on. We've seen that even a pattern with great stats, like the big W, has its flaws. It has throwbacks, and it has failures. So it makes you wonder,
Is the real secret to successful trading less about finding these perfect patterns and more about perfecting your own rules for how you deal with them when they are, inevitably, imperfect? Something to think about.
Welcome to The Explainer. Today we're diving deep into a rare and really powerful chart pattern, turning some complex market data into a clear, visual story you can actually use. So let's kick things off with a pretty provocative idea. What if a pattern's biggest, most obvious failure was actually its most profitable signal? Okay, take a look at this. This is the broadening bottom. You can probably see why it's also called a megaphone pattern, right? It just looks like volatility is expanding. Things are getting louder, more chaotic. But inside all of that noise, the data tells a surprisingly reliable story. All right, first things first. We need to know what we're actually looking for. So let's break down how to properly identify this pattern so we don't get faked out by just random market noise. So, based on some really thorough research from Thomas Bulkowski, these are the rules. It all has to start with a downtrend. Then you've got that classic megaphone shape, with two trend lines that are literally moving apart from each other. Now this next part is critical. You need at least 5 total touches of those lines, so maybe 3 on top and 2 on the bottom. And finally, the pattern is only officially on when the price closes outside one of those boundaries. That's your confirmation. So let's say you found one. It ticks all the boxes. The big question is, now what? Which way is it going to break? Well, the data gives us a very clear answer. After looking at over 600 of these patterns, it turns out there's a 61% chance of an upward breakout. That's a pretty significant edge, right from the get-go. And when it does break to the upside, we're not talking about some tiny little move. The average rise is a huge 41%.
Now compare that to the times it breaks down. Not only does it happen less often, but the average drop is only 16%. You can see the story the numbers are telling, right? The potential reward on the upside is just so much bigger than the risk on the downside, and that is our first major clue.
But hold on, the breakout itself isn't the whole story. What happens in the moments immediately after that breakout is just as important. And this is where it gets really fascinating. Let's look at the left side first, at throwbacks. After an upward breakout, the price will often drop back down to retest that old trend line. When that happens, the data shows it continues higher 72% of the time, a really strong confirmation. Okay, now look at the right side. After a downward breakout, you get a similar pullback. But here's the twist. After that pullback, the price only continues to drop 42% of the time. That's less than a coin flip. It's a massive warning sign that something is seriously wrong with this downward move. This little statistical anomaly is the key that unlocks the entire secret of this pattern. It really makes you ask the question, if the move down fails to follow through so often, what's really going on here? And that brings us to the core concept here. Sometimes, when a pattern looks like it's failing, when it busts, that can actually be the most reliable signal of all. This is where the real opportunity is hiding. So, it's really important we understand what busted means. It's basically a fake out. The price breaks in one direction, but it runs out of steam almost immediately. It doesn't move more than 10%. And then it completely reverses and closes on the opposite side of where it started. It's a classic false move. And here is the jaw-dropping number, a massive 39%, merely 4 out of every 10. Downward breakouts from a broadening bottom turn out to be these false moves. They bust. In the world of trading statistics, having a signal fail that often is just enormous. And this is what makes it all click. This is the hook from the very beginning. When that downward breakout fails and reverses, the rally that comes next is even more powerful than a standard upward breakout, averaging a 43% climb. The pattern's biggest failure literally becomes its most powerful success signal. Let's look at this on a real chart so you can see it. The pattern forms and then the price breaks down there at point E. But look, it barely goes anywhere. The drop to B1 is nothing, and then it rips higher, reverses, breaks out above the top of the pattern at C1 and just launches into this incredible rally. That is the busted pattern in action. So, the real question is, how do we turn all these stats into an actual edge? Well, the data gives us some very specific clues on what to look for. For those standard upward breakouts, the numbers show the best performance comes from patterns that form pretty quickly, in under 65 days, and after a sharp, nasty drop of more than 16%. If you can find that combo, the average rise is an incredible 48%. Now let's look at the other side. Even the best performing downward breakout, the one that forms quickly after a big drop, only averages a 19% decline.
This just reinforces that whole idea that trying to go short on this pattern is just riskier and a lot less rewarding.
Of course, none of this matters if you don't manage your risk properly. And, lucky for us, the data gives us a very precise, very clear guideline on where to place our safety net.
And wow, the numbers here are they're not subtle. For an upward breakout, if you put your stop loss inside the pattern, you have a 79% chance of getting stopped out too early. But if you just place it 1 penny below the pattern's absolute lowest point, that chance plummets to just 3%. It's the same logic, just in reverse, for the downward breakouts.
I mean, the source material couldn't be any clearer. It gives us this direct, actionable advice, all based on just overwhelming statistical evidence. You have to give the trade room to breathe by putting that stop just outside the pattern's boundaries.
So let's just wrap this all up. The broadening bottom is this rare megaphone that already leans bullish, but its real superpower is revealed when it looks like it's failing. A busted downward breakout is an incredibly potent signal for a huge rally. And, of course, managing your risk by placing your stop correctly is what makes the whole thing work.
And that leaves us with a final thought to take away. Maybe the biggest insight here isn't just about this one pattern, but about a whole new way of thinking. What other profitable failures might be hiding out there in plain sight, just waiting to be decoded?
All right, today we are diving into one of the wildest, most chaotic-looking patterns you'll ever see on a chart, the broadening top. We're going to break down what it is, what the data actually says about it, and how you can turn what looks like total chaos into a really clear opportunity. Okay, just take a look at this. I mean, it is all over the place, right? You've got higher highs and then even lower lows. It honestly looks less like a pattern and more like just noise, kind of like a megaphone just screaming with volatility. It's messy, it's confusing, and it feels completely unpredictable. But what if all that noise isn't random? What if this pattern is actually a map, giving us some really clear statistical clues about where the price is most likely headed? That's exactly what we're going to decode using some hard data from our source material. Okay, so first things first, we have to be sure we're actually looking at the right thing. Let's break down exactly how to properly identify this megaphone pattern, also known as the broadening top. So here's the textbook definition. It's a pattern with these two diverging trend lines. One slants up, the other slants down. And that's what creates that classic megaphone shape. Really, at its core, this pattern represents a fierce battle between the bulls and the bears, where both sides are just getting more and more aggressive. And that's what leads to those wilder and wilder price swings. To be absolutely sure you found one, you've got to use this checklist. Number 1, the price has to be in an uptrend before the pattern even starts. 2, you need that obvious megaphone shape. 3, and this one's super important, you need at least 5 total touches of the trend lines. So, maybe 3 on the top and 2 on the bottom. And lastly, in about 2/3 of cases, you'll see the trading volume also trending upward, right along with all that volatility. Okay, so you've spotted one in the wild. Now what? What does it actually mean for the stock's future? Let's get to the good stuff and see what the historical data tells us about where the price is most likely to go. Now, this is fascinating. Despite its name, a broadening top, the pattern actually breaks out to the upside 60% of the time. So it tends to act more like a continuation pattern than a reversal. A downward breakout, that happens the other 40% of the time. But it's not just about the direction, it's about the power of the move. I mean, look at the difference here. When it breaks upward, the average rise is a massive 40%, but when it breaks down, the average drop is just 16%. The potential reward on a good upward breakout is way bigger than the risk on a downward one. And that's a huge piece of this puzzle. But listen, a breakout isn't just a single moment in time, it's a process. And what happens after the price crosses that line is often the key to knowing if the move is for real. So let's look at the 2 classic post-breakout behaviors, throwbacks and pullbacks. And this illustrates the difference perfectly. So after an upward breakout, the price will often come back or throw back to test that old upper trend line. And on the flip side, after a downward breakout, it can rally or pull back to test the old lower trend line. It's that classic market behavior, turning old resistance into new support or the other way around. So, how often does this actually happen? Well, the data shows it's pretty much a coin flip. A throwback happens in 52% of upward breakouts, and when it does, the price continues on its way up 71% of the time. A pullback happens in 48% of downward breakouts, and then the price keeps dropping 61% of the time. For a trader, that's really valuable confirmation. All right, this right here is where things get really counterintuitive and honestly super powerful. We've talked about what happens when breakouts work, but what about when they fail? This is arguably the biggest secret of the broadening top pattern. And here's the crucial insight. A failed breakout isn't just noise. With this specific pattern, a failure is often a high probability signal pointing in the exact opposite direction. And just look at this data. Upward breakouts fail, or bust, about 28% of the time. Okay, but downward breakouts? They bust a staggering 44% of the time. That means nearly half of all the times this thing looks like it's breaking down, it fails. That is a huge statistical edge. So what exactly is a busted downward breakout? Well, the source defines it very clearly. The price breaks below the pattern, but then it fails to drop more than 10%. And then it doesn't just recover, it reverses and closes above the top of the entire pattern. It's a classic bear trap that just snaps shut on all the sellers. And here is the punchline. When this specific failure scenario plays out, the average rise that follows is a whopping 50%. That's even more powerful than the average successful upward breakout. This is the pattern's hidden gem, betting on the failure of what looks like a bearish move. Okay, we've gone through the data, we've seen the odds. So how do we actually use it? Let's walk through an actionable playbook with 3 distinct trading setups. So setup number 1 is the most powerful one we've seen, trading the bust. It's all about cashing in on that failed downward breakout. So first, you identify the pattern. Then you just wait patiently for it to break down. If that drop stays under 10% and then the price reverses all the way back up to close above the top of the pattern, that's your buy signal. Yeah, it's a counterintuitive trade, but the data says it's the most powerful one. Setup 2 is the ideal breakout. This is for those who prefer a more conventional trade. The data tells us that the highest probability upward moves happen under very specific conditions. First, the trend leading into the pattern needs to be short, less than 6 months. And second, the stock needs to have clear skies ahead with little to no resistance. Breaking out to all-time highs, that's the absolute textbook example. And this chart right here is a perfect illustration of that ideal setup. You can see that relatively short run-up into the pattern, and then the breakout just has nothing but blue skies ahead of it. This combination gives you the highest probability of a strong, sustained move higher. You know, the author of the study, Thomas Bulkowski, he puts it perfectly right here. It's a theme you see again and again in his research. Patterns that form after a short, energetic trend tend to perform way better than those that form after a long, drawn-out, exhaustive one. The stock just has more fuel left in the tank. And finally, just as important as knowing what to trade is knowing what to avoid. This is the setup that often looks tempting but is actually a trap. We're talking about a stock that's already had a massive run-up and is now approaching the ceiling of old prices. That's significant overhead resistance. Even if it does manage to break out, the author suggests the move is probably going to be weak and just fizzle out. The stock is simply too tired. So let's circle back to our original question. Is this megaphone pattern just a signal of random chaos, or is it a clear-cut map of probabilities? Well, the data strongly suggests it's a map. Now, it's not a crystal ball, but understanding these probabilities, especially the failures, can help turn that screaming volatility into a clear, calculated opportunity. All right, today we're going to talk about a real classic in the trading world, a pattern that can signal a huge shift in a stock's direction. It's called the double bottom, and we're diving right in. You know that feeling, right? You see a stock that's been falling, and you just get this itch, this urge to perfectly time it, to buy right at the bottom just before it takes off like a rocket. I mean, that's the ultimate goal, isn't it? Yeah, but there's a reason they call that catching a falling knife, because most of the time, that dream becomes a total nightmare. You think you found the deal of a lifetime, you jump in, and whoosh, the price just keeps on dropping. So that's the big problem we're tackling today. What if we could stop guessing? What if there was a clue, a signal right there on the chart that screamed, hey, this downtrend might be over? Well, that's exactly what the double bottom pattern is supposed to do. So here's what we're going to cover. We'll look at the signal itself, the golden rule of confirmation, the anatomy of the pattern, the ideal versus the real world, what happens when things go wrong, and finally, how to trade with the odds on your side.
Okay, first things first. What is this pattern really telling us? What's the story here?
The easiest way to think about it is like a bouncing ball. Imagine a stock price is falling, 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 and then thump. It hits a price level and bounces up. That's your first valley. Then it drops back down to test that same level again. If it holds, if it bounces off that same spot a second time, that's a huge clue. It suggests the sellers are running out of steam and buyers are finally stepping in, creating a solid floor.
All right, now this next part, this is probably the most important thing we're going to talk about. It's where almost everyone gets this pattern wrong. And let me tell you, getting it wrong is an expensive lesson. You see, just spotting two little valleys on a chart is not a signal to buy. Not even close. In fact, if you jump in just based on that, you're walking right into a classic trap. There's one more piece to the puzzle, and it's the piece that separates the real deal from a total head fake. So what is it? What's that one secret ingredient that takes this from a 50-50 guess to a setup you can actually have some confidence in?
It all comes down to this number, 44%.
Here's what that means. It's a big deal. The data shows that 44% of the time, a chart that looks like it's forming a double bottom just fails. It never completes the pattern. It only, and I mean only, becomes a valid signal when the price breaks out and closes above the little peak that formed between the two valleys. Before that happens, it's nothing. Just as the research calls it, meaningless squiggles on a price chart. You have to wait for that confirmation.
Okay, so we know we have to wait. But what exactly are we waiting for? Let's get practical and break this down into a simple 5-point checklist. All right, here's what you're looking for. Number 1, you need a clear downtrend. I mean, this is a reversal pattern, so it has to be reversing from something, right? Number 2, you need those two clear valleys, and they should be at more or less the same price level. 3, they shouldn't be too close together. They need some time to breathe. On average, we're talking about 49 days between them. 4, the bounce in the middle needs to have some oomph to it, often more than a 10% rise. And finally, number 5, the grand finale, the breakout. The price has to actually close above that middle peak. That's your green light. Let's make this real. Take a look at this chart of JCPenney. See? You've got the clear downtrend coming in. Then, bam, you get the first bottom at point A. It rallies up and then comes back down to form a second bottom at B, right around the same price. Now look at that bounce in the middle, up to point C. That was a 28% move, so it's definitely significant. But the key, the absolute trigger, was when the price finally gapped up and closed above the line at C. That's the moment it went from a potential pattern to a confirmed buy signal. Okay, so you've got a confirmed pattern. Great. But we're not done yet. There's another layer to this that can make a massive difference in how much money you might make. You got to ask yourself, what kind of double bottom am I looking at? Because trust me, they are not all created equal. Basically, it boils down to two types of setups. On one hand, you've got the dream scenario. This is where a stock is already near its all-time highs, it has a small pullback, forms the pattern, and then breaks out. There's nothing but blue sky above it, no resistance. Then you have the common reality. This is a stock that's been absolutely crushed for months, maybe years. It forms a double bottom way down in the basement. Even if it reverses, it has to fight its way through a giant mountain of sellers, all the people who are just dying to sell and get their money back. Check out this Alaska air chart. This is the dream scenario in action. The pattern formed right near the old highs, so when it broke out, it was off to the races. And get this, the data shows that this specific type of setup leads to an average gain of 89%. Just incredible. Now let's flip the coin and look at the common reality. This Elizabeth Arden chart tells a different story. The stock was in a nasty downtrend for a year, the double bottom forms, it breaks out, but then it immediately slams into that wall of resistance from everyone who bought higher. The average gain here? Just 30%. Now, 30% is nothing to sneeze at, but it's a completely different universe than 89%. This is why knowing which setup you're dealing with is so crucial for setting realistic expectations. But hang on. Even if you get a confirmed pattern and you're in the trade, it's not always smooth sailing. The price rarely just goes straight up in a perfect line. So let's talk about the risks. What can happen after you get in? So what are the odds? Well, a picture-perfect breakout is actually pretty rare. It only happens about 23% of the time. What's much more common, happening 58% of the time, is that the price will actually come back down to retest the level it just broke out from. And then there's the ugly outcome. About 19% of the time, the whole thing just busts. It completely fails.
So let's be clear on what these mean. That pullback we mentioned, that's called a throwback. It can definitely shake you out of a trade if you're not expecting it, but it's actually normal behavior. The real danger is the bust. That's when the pattern is a total failure, and the price not only reverses but falls below the original lows of the pattern. And since that happens almost 1 time in 5, you can see why having a plan for when you're wrong is absolutely non-negotiable. Okay, we've covered a lot. The good, the bad, the ugly. So how do we actually use all this information to trade smarter? Let's boil it all down into a super simple 3-rule playbook. Here we go. Rule number 1 is simple. Wait. Wait for that confirmation, that close above the middle peak. That's how you dodge that 44% failure rate right off the bat. Rule number 2, know. Know what kind of setup you're in. Is it the dream scenario with huge potential, or the common reality with more modest gains? Know what to expect. And rule number 3, and this one could save your skin. Place your stop loss. Put it just below the lowest low of the entire pattern. That way, if you end up in that 19% of trades that bust, you get out with a small, manageable loss instead of a disaster.
And really, that's the whole game. The double bottom isn't magic, but it is a map. It's a statistically backed guide that tells you where a reversal might happen, what a good entry looks like, and most importantly, where to admit you're wrong. All the information is there. The only question left is, when you see that map laid out in front of you on a chart, do you have the discipline to actually follow it?
All right, let's get right into it. We're talking about one of the most famous and, one of the most feared patterns in all of stock charting, the double top. It's that formation that pops up and makes a lot of traders think, uh-oh, a big drop is coming. But how true is that really?
Yeah, this is the classic take, right? It's so dramatic. The idea is you see those 2 peaks, it gets confirmed, and boom, it's time to get out before the whole thing goes under. It's a powerful, almost scary image.
And here's where it gets interesting. This is the big question we're going to tackle today. Because when you actually look at the hard data from thousands of these patterns, a much more complicated story starts to unfold. What if the legend doesn't quite hold up to reality?
So before we can bust the myth, we have to understand the myth itself. Let's first break down the legend, the textbook version of the double top that everybody learns about. Okay, so here's the basic recipe. You've got a stock that's been on a nice run, moving up. It hits a high point, pulls back a bit, and then rallies right back up to about that same price level, but it just can't break through. That failure creates these 2 twin peaks, and it's supposed to signal that the buyers are finally running out of steam. And this chart of 3M is, it's the poster child for the legend. You see it, right? The clear uptrend, the 2 distinct peaks hitting the same ceiling, and then whoosh, a massive drop. This is exactly why the pattern has such a scary reputation. It looks so clean, so predictable.
But now, it's time for the reveal. Because that perfect-looking example, it isn't the whole story. Not even close. The data, and we're talking about a huge study of over 14,000 patterns, tells us something completely different. It shows that the double top can actually be a pattern of deception.
So let's just stop for a second. Picture it. You're looking at a chart, and you spot what looks like a double top forming. You've got your 2 peaks. What do you think the chances are that it actually follows through and becomes a real confirmed sell signal? Take a guess.
The answer is pretty wild. 53% of the time, that pattern you're looking at isn't a double top at all. It fails. The price just shakes it off and keeps climbing, never actually confirming the bearish pattern.
Just look at this breakdown. It's basically a coin flip. Only 47% of the time do these twin peaks actually turn into a confirmed double top. So the biggest takeaway here is that just seeing 2 peaks means absolutely nothing. You can't panic. More often than not, the trend is just fine.
This brings us to the single most important piece of this puzzle, the one thing that separates a real warning sign from what the source material brilliantly calls just squiggles on the price chart. And that magic word is confirmation.
And this is it. This is the whole ballgame. That line at the bottom of the valley between the 2 peaks, that's your confirmation line. A double top is not, I repeat, not a valid pattern until the price closes below that line. Until that happens, it's just a potential pattern. And as we just saw, a potential pattern that fails more often than it succeeds.
Okay, so now we know we have to wait for confirmation. Let's dig a little deeper and perform an autopsy on a real double top. What are the key ingredients we need to look for to spot the real deal?
It's a pretty logical checklist, right? First, you've got to be in an uptrend, obviously. A reversal pattern needs something to reverse. Then you get your two distinct peaks around the same price. Third, the valley in between them needs to be a real noticeable drop. And then, the grand finale, step 4, the price has to actually break and close below that valley. That's the confirmation.
And here's a little pro tip from the data. The typical time between those two peaks is about a month. It can be shorter, it can be longer, but that's a good rule of thumb. If the peaks are, say, a year apart, they're probably not part of the same pattern. It's a useful little detail to keep in mind.
Okay, now this is where the story takes a huge turn. We talked about how often the pattern fails to even confirm. But what happens when it does confirm and then it still fails? This is the big twist, and it's where failure can actually create a massive opportunity.
So get this concept. It's called a busted top. Here's how it works. The pattern confirms, the stock starts to drop just like it's supposed to, but the drop is tiny, less than 10%. And then it does a complete 180, reverses, and just explodes back up, closing above where the old peaks were. The whole bearish signal just busts.
And how often does this happen? A jaw-dropping 38% of the time. Let that sink in. Nearly 4 out of every 10 confirmed double tops end up being a trap, failing to deliver a big drop and actually turning into a powerful bullish signal.
And look at the difference in the payoff. It's stunning. When a double top actually works, the average drop is about 16%. Not bad. But when it busts, the average rise after that is a massive 47%. The failed pattern is actually way more powerful than the successful one.
And here's what it looks like in the wild. This is Abbott Labs. You see the two peaks, you see the price break below the valley for confirmation, but the drop just fizzles out. Then it reverses, blows past the old highs, and takes off on that huge rally. It's an absolute bear trap, but for bulls who see it happening, it's a golden opportunity.
So with all this incredible data, how can we actually use it? Let's try to build a little playbook. The statistics give us a real edge by showing us which types of double tops are more reliable and which are more likely to trick us.
Okay, this is really interesting. The data shows that the length of the prior uptrend matters a lot. Double tops that form after a quick, sharp trend of 6 months or less tend to be way more potent. They lead to bigger drops, 17% on average, and they fail less often. The ones that form after a long, slow grind of a trend, they fail half the time.
And this might be the most practical tip of all: risk management. If you were going to trade this pattern from the short side, where do you put your stop loss? Well, the data is crystal clear. The statistically safest spot is just a little bit above the highest peak of the pattern. Why? Because that stop loss only gets triggered 1% of the time. That is an incredibly reliable place to protect yourself.
So let's bring it all home. The big takeaway is pretty simple. The double top is not the straightforward, deadly signal that everyone thinks it is. It's a really complex pattern. It fails to even confirm more than half the time, and even when it does, it's got a very high chance of busting and turning into a huge bullish reversal.
And that leaves us with one final thought. When you're looking at a chart, what really matters more? Is it the classic shape you see with your eyes, or is it the hard statistical probabilities that you know are behind that shape? Something to think about.
You know that feeling? A company you own just dropped some bad earnings news. It can feel like a fire alarm going off in your portfolio, and your first instinct is just to get out and get out fast. But what if I told you there's a surprisingly predictable pattern that stocks tend to follow in all that chaos? Well, today, we're going to break it down.
Yeah, we've all been there. You see that sea of red on the screen, your stomach just drops, and you're hit with this exact question. Do you sell, cut your losses and move on, or do you grit your teeth and hold on, hoping it'll bounce back? It's a huge decision, and honestly, what you do in the next few hours or even the next few minutes can make all the difference. You know that immediate urge to hit the sell button? It feels like you're taking control of the situation, right? But reacting with your gut, with that panic, is almost never the best move. The good news is, behind all that emotional noise, there's actually a framework backed by data that can help you turn that panic into a calm, calculated observation. Right. What if it's not so chaotic after all? Based on a massive study looking at thousands of these exact events, a clear pattern starts to emerge from all the noise. And once you understand it, it's like having a map for what to expect in the days and weeks ahead. So the author of this study calls this pattern the tennis ball bounce. And I love that because it's such a perfect visual for how a stock behaves after getting dropped by bad news. Let's take a look at the map itself. Okay, and here it is.
This simple-looking chart is the key to the whole thing. And this isn't just a guess or some theory. This is the median path, the average journey pulled from over 4,800 real-world earnings misses. It shows you the typical trip a stock takes after that initial shock. Let's break down each stage of that trip. So, the whole thing usually plays out in 4 phases. First, you've got that initial one-day drop, which is a median of about 3%. But here's the thing, it rarely stops there. Over the next week, it keeps sliding down to what's called the event decline, hitting a low of around -8%. But then comes the surprise, the bounce. Over the next 20 days or so, the stock actually recovers, and sometimes it gets all the way back to where it started. But the story isn't over. After that little bounce, it tends to fall again, finding its true bottom at a median of -14% after about 38 days.
And this quote just nails it, doesn't it? The stock doesn't just smash into the pavement and lie there. It hits the ground hard. It has a surprisingly big bounce back up, and only then does it continue to roll down to its final resting place. Drop, bounce, roll. It's a really powerful way to picture what's happening.
All right, so a clean theoretical model is one thing, but does this pattern actually show up in the messy, chaotic real world of trading? Let's take a look at an actual stock and see what happened.
So on the left, there's our clean model again, and on the right, that's the real-life chart for Alaska Air after a bad earnings report. Just look at how closely it follows the script. You can see it clear as day, that initial drop, the continued slide to a low, that classic unmistakable bounce, and then the final drop to the ultimate low. It is wild how closely it matches the model. And if you look at the actual numbers for Alaska Air, the moves were even bigger than the median. It dropped 9% on day 1 and then fell all the way to -16%. But then, and this is the crucial part, look at that bounce. It clawed its way almost all the way back, recovering to just 3% below its starting price. I mean, if you had panicked and sold anywhere near that bottom, you'd have been kicking yourself. But true to form, the pattern completed, and the stock then fell again to its ultimate low of -18%.
Okay, so we've seen the pattern exists, but how often does it happen? How reliable is it? Let's dig into the stats behind these moves, which are kind of like the rules of the game.
So just how consistent is this?
Well, the data is pretty incredible. That tennis ball bounce happens a whopping 75% of the time, 3 out of 4 times. But that also means that a quarter of the time, stocks just skip the bounce entirely and fall straight down to their low before recovering. And that is a really important exception to keep in the back of your mind.
And here's where things get really counterintuitive. You'd think that bounce is a good thing, right? Like a sign of strength? Well, the data says nope. Get this, stocks that do bounce actually end up falling almost twice as far, a median drop of 17% compared to just 9% for the ones that don't. That bounce can be a really dangerous trap, giving you false hope right before the next drop.
You know, this whole research project wasn't just some academic exercise. It was actually born from a very painful, real-world trade. This chart right here shows the author's position in a company called Albemarle Corp. after a bad earnings report sent the stock into a nosedive. So this whole framework was built to solve a very real, very frustrating problem. The author panicked, sold at the absolute worst possible moment, and then had to sit and watch the stock recover without him. That one costly mistake is what sparked this whole investigation, so that maybe others could avoid doing the exact same thing. Okay, this is all fascinating theory, but what do you actually do with this information? Well, the answer really depends on your timeline as an investor. So let's break down the takeaways for a few different styles. All right, for swing traders, you're the ones holding for just days or weeks. This pattern is basically your playground. The data shows the cleanest, simplest move is often just to sell right on announcement day. But if you miss that chance, another strategy is to wait out that initial drop and aim for the bounce. And remember this amazing stat, half of all stocks that bounce make it all the way back to break even. That gives you a much better exit than selling in a panic at the low point. Now, if you're a position trader holding for months, the story is very different. For you, one earnings miss is not a fire alarm. In fact, think about this. Almost 70% of stocks that miss earnings hit their final bottom before they even drop 20%. So for you, the question isn't about timing the bounce, it's about the bigger picture. Has the fundamental story of this company actually changed, or is this just some short-term market drama? And what about for the true long-term buy and hold investors? Honestly, this entire pattern we've been talking about is mostly just a blip on the radar. Get this. A stunning 97% of stocks that miss earnings drop less than 50% from that miss. So unless the bad news points to a really deep, serious problem with the company's future, this short-term dance is something you can and probably should just ignore.
So look, the big takeaway here is not some foolproof way to time the market. This isn't a crystal ball. It's a mental map. Just knowing this pattern exists can help you stay calm when everyone else is freaking out. It lets you make a strategic decision instead of a purely emotional one.
So let's end with a little challenge. This is a chart from Monster Worldwide. You can see that earlier, back at point A, they missed earnings and followed the tennis ball pattern perfectly, bouncing right back up to break even at point C. But now, look over at point E. It just happened again. A second bad earnings report in a row. The stock is gapping down hard. The news is bad, and it's the second major warning sign. You now know the predictable path this stock is probably about to follow. So the question is, what's your move? You know those classic chart patterns, flags and pennants? Yeah, you've probably seen them a million times. They seem so simple, right? Well, what if I told you that the data shows most people are getting them completely wrong? That's what we're going to unpack today.
And you know, this quote from Thomas Bulkowski, who actually did the heavy lifting on the data for this, he just nails it. He calls them the hand tools of trading. I love that. It's perfect, right? They're basic, you see them all the time, and pretty much everyone assumes they know exactly how they work. But that's where the story gets really interesting. What happens when those simple tools don't behave the way you expect? What if, and this is the crazy part, the best way to trade one of these is to wait for it to completely fall apart? Yeah, you heard that right. Let's get into the numbers. Okay, so before we dive into the really juicy, surprising stuff, let's just do a quick refresher. We got to make sure we're all talking about the same thing. What exactly is a flag or a pennant?
It's super simple, really. The only difference is the shape. A flag looks like a rectangle, and a pennant looks more like a little triangle. But honestly, for how we trade them and for what the data says, they're pretty much identical.
Okay, check this out. This is a perfect textbook example of a flag. But here's the thing that a lot of people miss. The most important part happens before the flag even shows up. See that huge sharp move up? That's the flagpole. And let me be clear, no flagpole, no flag. It's the one rule you absolutely cannot break. So when you're hunting for these, here's your checklist. Number 1, gotta have that big explosive flagpole. Number 2, the pattern itself has to be quick, like 3 weeks max. It usually drifts down a little, like the market's just catching its breath. And number 3, and this is a big one, watch the volume. It should really dry up while the flag is forming. Think of it like a spring coiling up, just storing all that energy for the next pop. All right, so now you know what to look for, and this is why traders' eyes light up when they spot one. The numbers on these are, well, they're pretty convincing. The odds of the trend just picking up where it left off are, frankly, huge. Get this, when that flagpole is pointing up, the data, and we're talking over 1,000 real examples here, shows an 84% chance that the price breaks out higher. I mean, come on, 84%. That's a massive edge.
And it's pretty much the same story in reverse. If the flagpole is pointing down, you're looking at an 82% chance of a breakdown. So yeah, the odds are just screaming that the trend is your friend here. So you look at this and think, wow, this is a slam dunk. See the pattern, check the odds, make the trade. It's just a little pit stop before the rocket takes off again. Seems like easy money, doesn't it? Well, not so fast. Because this is where everything changes. That breakout you were waiting for, that's not the finish line. A lot of the time, it's the start of a trap. It's the most dangerous moment of the whole setup. Bulkowski has this incredible line. He calls them landmines waiting to explode, and he's talking about something called a throwback. So here's what happens. The price breaks out, everything looks great, you're in the money, and then bam, it reverses hard and comes right back down to the pattern. It's a classic head fake designed to kick you out of a perfectly good trade. And just look at this. This is what's so wild. It's not rare. It happens 52% of the time. That's more than half. The stock breaks out, sucks everybody in, and then it pulls the rug out from under them, takes out their stops, then it decides to go higher. It's brutal. And here's the real pain. You do what you're taught, right? You set a smart stop loss just below the flag. Well, a quarter of the time, 24%, you're going to get stopped out for a loss on a winning trade. And for bearish flags, it's almost 30%. Just think about how frustrating that is. You got the direction right, and you still lose money 1 out of every 4 times. Okay, so that's the problem. But what if that failure, that trap, is actually the real opportunity? What if we've been looking at this backwards the whole time? This is where we shift from the obvious trade to the pro move. So let's be super clear on what we're talking about here. A busted pattern is when you get a breakout, but it's weak. It doesn't really go anywhere, maybe less than 10%. And then, all of a sudden, it flips, reverses, and smashes through the other side of the pattern. It's the ultimate gotcha move, and boy, is it powerful. Now, this is what I find so cool about the data. It's not symmetrical. If an upward breakout fails, you get a decent drop, about 21%. That's nice. But look at what happens when a downward breakout fails. This is the real money move. It happens more than 1/3 of the time, and when it does, the average move is a 44% rise. Let that sink in. 44%. This means the best, most explosive signal this pattern can give you is when it completely fails. Why? Because all the short sellers get trapped. They're forced to buy back their shares to cover their losses, and that buying just fuels a massive, massive squeeze higher. The failure itself becomes the fuel for the rocket.
Okay, so this is a lot to take in, right? We've got the basic odds, we know about the throwback traps, and now we know about the insane power of a busted pattern. So the question is, how do we tie all this together to find those really great day setups?
Well, it turns out there's one thing that's more important than anything else we've discussed. And it's so simple. The big picture. The long-term trend. At the end of the day, are you swimming with the tide, or are you trying to fight it?
And this right here shows you exactly what I mean. On the left, you've got a flag that's just a little pause in a huge, strong uptrend. That's what you want to see. That's the A+ setup. On the right, it's a flag, sure, but it's happening during a tiny little bounce and an overall downtrend. That's a sucker's bet. The big takeaway is simple. Only take the long side on flags when the whole chart is already pointing up.
And here it is, the final cherry on top. If you can find a flag that breaks out to all-time new highs, what traders call blue sky territory, those are the ones that really fly. There's no old resistance, no ceiling of sellers waiting to dump their shares. And the numbers back it up, a 25% average gain versus only 16% for those that have to fight their way through old price levels. It's like taking off with a clear runway versus a bumpy one. So let's boil it all down into a simple game plan. 1, what's the primary trend? Make sure it's up. 2, find a proper flag or pennant. 3, your goal is to trade with that trend, and a breakout to new highs is the dream setup. 4, and this is key, don't get scared by a throwback or a bust. See it for what it is, a second chance opportunity. And 5, of course, always know where you're going to take your profits.
And that really brings us full circle. That simple hand tool we started with, it's actually way more sophisticated than it looks. It's full of traps for sure, but also incredible opportunities if you know where to look. Knowing what the data really says about throwbacks, about busted patterns, about the power of the primary trend, well, it just changes the whole game. So the only question left is, now that you know, are you ever going to look at a simple flag the same way again?
We've all been there, right? Staring at a stock that's just been tanking, and you're asking yourself, is this it? Is this the bottom? It's got to be one of the toughest calls to make in trading. But what if there was a classic chart pattern that could actually give you a statistical edge?
I mean, that's the million-dollar question, isn't it? If you get it right, you could be setting yourself up for a brand new uptrend. But if you get it wrong, well, you're just trying to catch a falling knife. Today, we're going to dig into the data behind one potential answer to that very question. So, say hello to the head and shoulders bottom. Now, I know, it might just look like a few random bumps on a chart, but this specific formation, it's been studied like crazy. It's a potential signal that the entire power dynamic between buyers and sellers might be on the verge of a major shift. All right, so before we can even think about using this thing, we've got to know what we're looking for. We need to break down its anatomy. It's made of a few key pieces, and trust me, once you learn to spot them, you'll start seeing this pattern pop up all over the place. Everything kicks off right here with the left shoulder. So if the stock's been heading down, it finds a temporary floor and then bounces a little. This first little dip is super important. It really sets the scene for everything that comes next. Then, the sellers come back with a vengeance. They push the price down again, and this time it goes even lower than the left shoulder. This creates the head, and you gotta understand, this is the point of maximum fear, right? The absolute lowest point of the whole pattern. Okay, so after we hit that low point, the buyers try to make a comeback, but they just don't have enough juice. The price drops one last time, and that forms the right shoulder. Now here's the magic moment, the key observation. This right shoulder bottoms out at roughly the same level as the left shoulder. That symmetry, that's a huge tell that the sellers are finally getting tired.
And now we get to the most important part of this whole setup. I'm talking about the neckline. You literally just draw a line connecting the two little peaks that are nestled between the shoulders and head. This line is the whole ballgame. It's the trigger, the final confirmation that tells us we might have a real actionable signal on our hands. All right, let's wrap this up in a neat little package. The head and shoulders bottom is basically a reversal pattern with 3 valleys. The one in the middle, the head, is the deepest. The 2 on the sides, the shoulders, are a bit shallower and more or less at the same level. But, and this is a big but, the pattern is not official, it's not confirmed, until the price breaks out and closes decisively above that neckline.
Okay, so the pattern's in place, we get the breakout above the neckline. So what happens now? Well, this is where the data gets really, really interesting, because it's not always just a straight shot to the moon.
So, get this. Based on a huge study, we're talking over 2,800 of these patterns, the average rise from that breakout point all the way to the peak is a whopping 49%. Just let that sink in for a second. This isn't some tiny little bounce we're talking about. This is a full-blown trend reversal. That's the kind of potential we're dealing with when this pattern works out. But does the price always just blast off like a rocket? It's a fair question, right? You see that breakout, the adrenaline starts pumping, you're expecting big things. But in reality, things can be a little more, let's say, complicated. The data shows there's a very common and, frankly, a pretty nerve-wracking pit stop that often happens. Check this out. In 56% of cases, so yeah, more than half the time, the price does what's called a throwback after it breaks out. What's that? Well, it pulls back to basically kiss that neckline it just broke through goodbye. Only 44% of the time does it just keep on rising without looking back. So believe it or not, a little pullback is actually the more likely scenario. And this is where it gets really interesting, because there's a trade-off. You might think waiting for that pullback is the safer play. But the data shows that the stocks that don't pull back, the ones that just take off and run, they tend to be the real superstars, averaging a 57% rise. The ones that do have a throwback, they still do great, don't get me wrong, but their average rise is a bit lower at 43%.
Okay, so with all this info, how do we find the best of the best? How do we separate the A-plus setups from the just okay ones? Well, the research points to a few key things to look for.
Yeah, we can actually boil this down to a pretty simple 3-step checklist. First, make sure you're actually reversing a downtrend. That's kind of the whole point. Second, you want to look for patterns with not a lot of resistance above them, what traders call blue skies. And third, and this one is so important, you've got to check the longer-term primary trend.
And man, this chart really hammers that last point home. Look at this. The data is crystal clear. Patterns that show up after a year-long downtrend or a flat trend do way, way better. We're talking average gains of 54% and 55%. But the ones that form inside a bigger ongoing uptrend, they seriously underperform. So what's the takeaway? It's simple. You want to use this as a true reversal signal, not just a little pause in a stock that's already going up.
Look, let's be real. No chart pattern on Earth works every single time. And a big part of trading smart is knowing what failure looks like, how often it can happen, and what the potential damage could be. So, the research tells us that about 14% of these patterns will bust. A bust is when it breaks out, looks good for a minute, but then totally fails, reverses, and ends up falling below the low of the head. Now, 14% is not most of the time, but it happens often enough that you absolutely must have a plan for it. So let's just lay the odds out on the table, nice and clear. On one side, you have that potential reward we've been talking about, that average gain of 49% when the pattern works. That's your upside. But on the other side of the coin, you have the risk. When one of these patterns busts, the average drop is 22%. And seeing these two numbers side by side, well, that's exactly why having a risk management plan isn't just a good idea, it's everything. But hold on, here's one last little twist in the data that's pretty surprising. Even within that 14% of patterns that fail, 3/4 of them actually end up dropping less than 20%. So what does that tell us? It suggests that while busts are definitely real, a lot of them don't turn into a complete 5-alarm fire. So at the end of the day, is this a crystal ball?
No, of course not. No chart pattern can predict the future with 100% certainty. But that's not the point. What it can do is help you spot a situation where the probabilities might just have shifted in your favor. The head and shoulders bottom isn't a guarantee. It's a statistical edge backed by data. And the real question is, how are you going to use those odds?
All right, let's dive right in. Today, we're breaking down what might just be the most famous warning sign in all of technical analysis, the head and shoulders top. But look, this isn't just some textbook theory. Our whole explainer is based on a deep dive statistical analysis of nearly 2,500 real-world examples. So let's see what the data really tells us.
So, why all the fuss about this one pattern? Well, here's why. On average, once this pattern is confirmed, the stock price plummets 18%. Now that is a huge move, and it's exactly why every trader needs to understand what they're looking at when this shape appears.
And this right here, this is the shape that comes right before that 18% drop. I know, it might just look like a bunch of squiggles on a chart right now, but by the end of this, you'll see a very clear story of supply and demand playing out.
Okay, first things first, we've got to learn how to spot this thing correctly. Because let's be honest, if you get this part wrong, every single decision you make after that is going to be based on a faulty premise.
So the most important point is right there in the definition. The shape itself is just a potential setup. The pattern is not officially on. It is not a valid signal until the price makes a decisive move and closes below what's called the neckline. Without that specific event, you just don't have a trade.
You know, the parts of the pattern are actually really intuitive. You can clearly see the left shoulder, then a higher peak which makes the head, and then a second lower peak that forms the right shoulder. The neckline, that's just a simple line connecting the low points. You can think of them as the armpits between those three peaks.
This gives us a really clear checklist. First, the shape has to be proportional, kind of like a bust, so no weird stretched out patterns. Second, it should be pretty symmetrical, with the shoulders hitting roughly the same price and being about the same distance from the head. Third, you draw that neckline. And finally, the most critical step, you have to wait for confirmation. The signal only goes live after the price closes below that line.
Okay, so you've identified a valid pattern and the price is officially broken down. What does the data say happens next? Let's take a look at what a successful downward move actually looks like.
Now, this is one of the most fascinating little nuggets from the research. You might think a long, slow climb would lead to a bigger crash, right? But the data says the exact opposite. A stock that rockets up aggressively right before forming this pattern tends to fall much, much faster afterward.
And the numbers really back this up. A short, steep trend, we're talking less than 6 months, leads to an average drop of 19%. Compare that to a longer, more gradual trend where the drop is a little milder at 15%. So yeah, the context of the trend before the pattern is a huge clue about how bad the drop might be.
But here's the thing about trading. No signal is ever perfect. And what the data shows us about the failures of this pattern is, in a lot of ways, even more interesting than when it works.
So while this pattern is definitely reliable, it's not foolproof. The data shows it works out like you'd expect about 70% of the time. But in the other 30% of cases, the pattern busts, meaning the downward break fails and the price reverses and heads up. That's a failure rate you absolutely have to factor into your thinking.
Now for another little nuance. Even among the patterns that do eventually work, 62% of the time the price will first come back to the breakout level. This is called a pullback, and it happens in almost 2 out of every 3 successful trades.
Think of a pullback as the market taking a little breather. The price breaks down, then it rallies back up to test that old support level, which is now resistance, before it continues lower. For traders who might have missed that initial breakdown, this can actually offer a second chance to get in on a short position.
So we've covered what happens when it works, and that common pullback behavior. But what about that 30% of the time when it completely and utterly fails? Well, this is where a major warning sign can flip on its head and become a surprise buying opportunity.
So let's just ask the question. What happens when a pattern designed to signal a big drop just falls apart? Where does the price go then?
Take a look at this chart. You see the classic head and shoulders setup. The price broke below the neckline, signaling a sell-off, but the drop was tiny. Then all of a sudden, the buyers stepped back in with a vengeance, pushing the price not just back up, but all the way past the highest point of the pattern, the head.
And here is the punchline. When a head and shoulders top busts like that, the rally that follows is incredibly powerful.
The average gain after this specific type of failure is a massive 47%. The failed bearish signal becomes a powerful bullish one.
And the data gives us a clear playbook for this exact scenario. First, you confirm it's a valid pattern. Second, the price breaks down, but the drop is really shallow, no more than 10%. Then comes the key trigger. The price reverses and closes above the head. That's your buy signal right there.
Okay, we have covered a lot of ground. Let's try to distill all of this data into a clear, actionable playbook that you can actually use the next time you see this pattern in the wild.
First off, risk management. If you're going short on a confirmed breakdown, betting on that price drop, where do you place your stop loss? Well, this table shows the trade-off. A really tight stop just above the breakout point, it gets hit almost half the time. The safest stop, with only a 1% chance of being hit, is a penny above the head. But if that stop gets hit, your loss is bigger. It's a decision you have to make based on your own comfort with risk.
So let's bring it all together. First, make sure you have a valid, well-formed pattern, and then wait for the downward breakout. Next, think about velocity. Remember, a steep trend beforehand often leads to a steeper drop. But always be ready for it to fail, because a busted pattern can turn into a monster buying opportunity. And finally, always know where your stop loss is placed before you even think about entering a trade.
And that's really the key takeaway from all this data. This famous shape isn't just telling one story, it's telling two. It's a powerful warning of a potential 18% drop, but hidden inside its failure is an even more powerful signal of a potential 47% rise. The question is, which one will you be ready for?
Today, we're going to dig into a really powerful chart pattern, one that can help you get a feel for a stock's next big move. It's called the measured move down. And trust me, it's a fantastic tool for reading the story a stock chart is telling you.
You know the feeling, right? You're looking at your screen, it's all red, and a stock is just dropping. And the big question is always, where's the bottom? Is this just a little dip, or is this the start of something much, much worse? It can feel like pure guesswork, but what if there was a pattern that could give you a serious clue?
So, here's our game plan. First, we'll ask if a plunge can even be predictable. Then, we'll dissect the pattern itself. After that, we'll look at the two directions a stock can go after the pattern. We'll learn a predictive tool called the measure rule, and then see how it all works in a real-world trade. And of course, we'll wrap it all up with the key takeaways.
So let's get right to it. Can that plunge actually be predictable? Well, according to technical analysis, the answer is pretty often, yeah. The key is spotting this recurring formation known as the measured move down.
Now check this out, because this is where it gets really interesting. The guy who literally wrote the book on chart patterns, Thomas Bulkowski, he points out that this downward pattern is also a wonderful tool for figuring out how far a stock might rise once it's over. Kind of wild, right? It's like a 2-for-1 deal.
Okay, so what are we even looking for? To really spot this thing in the wild, you have to understand its 3 distinct phases. It's all about the rhythm of the stock's move.
At its heart, the pattern is actually super simple. It just looks like a zigzag, or maybe a letter Z that's tilted downwards. That's it. This simple shape is the foundation for everything we're about to discuss, so just kind of burn this image into your brain.
Think of it like a 3-act play. Act 1, you get this sharp, almost straight-line drop. Boom, that's the first leg. Then, in Act 2, the stock kind of catches its breath, right? It bounces back up a bit. That's what we call the corrective phase. And finally, Act 3, the sellers come back in full force and you get another big drop, one that often looks a whole lot like the first one. So it's simple. Drop, retrace, drop.
And listen, this isn't just some vague idea. People have studied this. Based on over 1,000 of these patterns, the data is pretty wild. The typical drop for that first leg, 18% over about 17 days. And the second leg, you guessed it, almost exactly the same, an 18% drop over 16 days. It's that symmetry, that mirroring, that gives this whole thing its predictive juice.
Okay, so the pattern plays out. Drop, retrace, drop. Now what? Well, the stock has basically reached a fork in the road. It's going to break out, and it can go one of 2 ways.
And here's the thing, it's not a coin flip. The odds are definitely skewed. The research shows that about 2/3 of the time, we're talking 67%, the stock just keeps on falling. That's the most likely outcome. But, and this is a big but, in that other 1/3 of cases, the pattern actually marks the rock bottom, and the price just reverses and shoots upward. And this slide really shows you what those two paths look like. On the left, if it breaks down, it usually falls another 9% or so. But look at the right side. When it breaks up, that move is way more explosive. We're talking a median rise of 24%.
So yeah, the upward breakout is less common, but man, when it happens, it is powerful. Okay, now for the part you've probably been waiting for. How can we actually use this pattern while it's happening to guess where it's going to stop? This is where a super handy tool called the measure rule comes into play.
The idea behind it is really straightforward. Since we know those two downward legs are often pretty similar, we can just use the length of the first leg as a kind of measuring stick to predict where the second leg is going to end.
But how you use that measuring stick is absolutely crucial. Check this out. If you assume leg 2 will be a perfect mirror of leg 1, 100% of the drop, you'll be right about 54% of the time, which, is okay. But if you're a bit more conservative and you only project 70% of that first leg's drop, your success rate just skyrockets to 90%. I mean, come on, that is a massive statistical edge.
Let's see this 70% rule in the wild. So first, you measure the price drop of that first leg from point G down to H. Then you just take 70% of that distance and you project it downwards from the top of that little bounce, which is point I. And would you look at that? It gives you a price target that just perfectly nails the bottom of the second leg at point J. That's what we mean by predictability.
All right, so we've got the theory, we've got the stats, we've got the tools. Now let's put it all together and walk through how you might actually trade this thing in the real world.
So first things first, you have to spot the setup. Here we are looking at a chart of Albemarle Corp, and you can see a really clean measured move down. Sometimes you'll hear traders call this an ABCD pattern, which is the same thing. The drop from A to B is leg 1, the bounce to C is the correction, and that final drop to D is leg 2. It fits the bill perfectly. So now we just sit back and watch what happens next.
Okay, so the trigger to actually make a trade isn't just when the pattern finishes. You need some kind of confirmation. So after the price bottoms out at D, it dips again, but it stops at point E. And notice E is a higher low than D. That's huge. It means the sellers couldn't push the price down as far as they did before. That's a classic signal that they might be running out of gas. That's our cue to think about buying, so the entry happens at point F the next day.
So what happened? Well, the initial price target is a move back up to that middle corrective area, that line at G. And sure enough, the stock rallies and hits it. But it doesn't stop there. So to manage the trade, you could use something called a trailing stop. Basically, it's an order that follows the stock up, locking in profits. In this case, it was placed just below the previous day's low. This lets you ride that upward trend until the stock finally stumbles at point J, which closes out the trade and, boom, locks in a 12% profit in about a month. Not bad at all.
Okay, we have covered a ton of ground, so let's boil this all down to the absolute must-know points you need to walk away with.
All right, let's recap the big stuff. First, you're always looking for that three-part rhythm. Drop, retrace, drop. Second, remember that those two down legs? They're often twins, very similar in length. Third, the odds say the stock is more likely to keep dropping after the pattern. There's a 67% chance of that. Fourth, and this is a big one, that 70% measure rule is your best friend for predicting the bottom. It's crazy reliable, hitting its target 90% of the time. And finally, here's a little pro tip. Even if the stock keeps falling, watch for a bounce back to that middle corrective phase area. It happens all the time.
The measured move down is such a cool tool because it brings a little bit of order to what can feel like total chaos in the market. Learning to see it is kind of like learning a new language that the charts are speaking. So I'll leave you with this question to think about. Now that you can spot this pattern, what other shapes, what other stories might be hiding in plain sight on your own charts?
You ever look at a stock chart and it's just chaos, right? A total mess. And you're just wishing you could find some kind of order, some predictable rhythm in all that noise. Well, guess what? Sometimes you can. Today, we're going to decode one of the most reliable continuation patterns out there, the measured move up. So here's our game plan. We'll kick things off with what this pattern actually is. Then we'll get into the nitty-gritty numbers behind it. After that, it's all about the practical stuff, how to actually spot one in the wild, what it tells us about the future, and finally, what it all means for you. Let's do this. All right, first things first. What in the world are we even talking about when we say measured move up? Let's break it down into its simplest parts. At its heart, it's really just a simple 3-act story. Act 1, a big, strong move up in price. Act 2, the price kind of chills out, takes a pause, pulls back a little. And then Act 3, another big move up, and here's the kicker. It's usually about the same size as the first one. And this visual just lays it out perfectly. You've got that first leg. That's your initial explosion higher. Then you get the corrective phase. Think of it like a quick breather, where the stock gives back just a little bit of its gains. And finally, boom, the second leg kicks in, and the uptrend is back on. That simple zigzag shape, that's the DNA of the whole pattern. Okay, so now we know what it looks like, but let's put some real numbers to it. What does the data say a typical measured move looks like? How big are these moves and how long do they usually take to play out? Now, before we flash the numbers, there's a really important idea here. The stats we're about to look at are medians, not averages. What does that mean? It means this is the most typical, right-in-the-middle example. So half of all the patterns studied did better, and half did worse. It gives us a super solid baseline for what we should expect to see. And here we go, the numbers themselves. That first leg, on average, shoots up 26% in about 3 weeks. Then, during that corrective phase, the price actually gives back almost half of that gain, a 47% retracement, over a similar stretch, about 19 days. The author of the study actually calls this the stock taking its lunch hour, which I kind of love. Then the second leg fires back up, climbing 24% in 20 days. You see that beautiful symmetry? It's almost a mirror image in both how much it moves and how long it takes. Just think about that for a second. A 26% climb. This isn't some tiny little drift up. It's a real, powerful statement of momentum. And then comes the pause, a 47% pullback. I mean, that's enough to scare a lot of people out. But for those who know this pattern, it's just part of the process.
And this is the payoff, another 24% climb. You see how close that is to the first leg? That incredible symmetry is exactly why they call it a measured move. The second part is a near-perfect echo of the first.
Okay, so we've got the theory, we've got the numbers. That's all great. But how do you actually find one of these things on a real, live, messy chart? Let's go over the key things to look for. So here's your checklist. First, you're looking for that initial leg to be a sharp, almost straight line move up. Then you watch that corrective phase. It needs to pull back, but, and this is super important, it can't fall below where the first leg started. After that, you need to see another strong, confident move up that breaks to a new high. And finally, just take a step back and eyeball it. Does the whole thing look proportional? The two legs should look and feel about the same length. And check this out. Here it is in the real world. This chart of Alaska Air shows two gorgeous examples, one right after the other. Take a look at that first one, from A to D. See that sharp first leg, the shallow little correction, and then that powerful second leg? It follows all the rules. And then, what do you know? It does it all over again with the second pattern. This is exactly what you're hunting for. So you've done it. You spotted a textbook measured move up. The second leg is finished. So now what? Well, this is where things get really cool, because this pattern's predictive power is seriously impressive. This right here, this is the headline. This is the big number. Once that pattern is complete, the price is going to break out of that range, and it breaks out to the upside 85% of the time. Let me say that again, 85%. That's a huge edge, telling you that the uptrend is very, very likely to keep going. And the results are pretty significant. In those 85% of cases where it works, the stock keeps running for another 19% on average. And for the rare 15% of the time that the pattern fails, well, the price usually drops about 10% below where the whole thing started. So the potential reward and risk are laid out pretty clearly for you. So if we're pretty sure it's going to go up, the next question is obvious. How far up? Well, we can actually make a really good guess using something called the measure rule. It's a simple little bit of math that uses the pattern's own shape to project a price target. And it's as easy as 1, 2, 3. Step 1, figure out the height of that first leg, from its bottom to its top. Step 2, take that number and just add it to the lowest point of the corrective phase. Step 3, the number you get is your price target. That's your prediction for where the second leg will top out. Let's see it in action. On this chart for Alkermes, that first leg was a run-up of $12.11. So you add that to the bottom of the correction, and you get a price target of $50.37. And where did the stock actually peak? $50.97. I mean, come on, that is ridiculously close. Okay, let's pump the brakes for just a second for a dose of reality. While that last example was, picture perfect, the full measure roll only hits its target that cleanly about 42% of the time. But, and this is a huge but, here's the pro tip to boost your success rate to over 90%. Yeah, you heard that right, 90%. You just have to be a little more conservative. Instead of using the full height of the first leg, multiply it by 60% and use that smaller number for your projection. It's a less ambitious target for sure, but it's a way more reliable one.
All right, let's wrap this all up. Let's talk about the takeaway. Beyond just spotting the pattern, what are the little details, the nuances that can really give you an edge? It all comes down to that corrective phase.
So, how deep that pullback is tells you a ton. If the price barely pulls back, we're talking less than 38% of the first leg, then the second leg is probably going to be a little shorter too. But if you see a really deep retracement, one that gives back more than 62% of the first leg's gains, the data shows the second leg is actually likely to be longer than the first. That happens almost 2/3 of the time.
And that brings us right back to the central idea, perfectly summed up here by the author himself. This whole thing is built on symmetry. The starting assumption is that the second move is going to mirror the first. And that simple, powerful principle is the foundation for everything we've talked about today.
So there you have it, a pattern that can signal a stock's next move with 85% probability, and it even gives you a tool to project how high it might go. It's all about finding that predictable rhythm in what looks like random noise. So the only question left is, now that you know exactly what to look for, what are you going to see in the charts?
All right, so today we're going to dive into a chart reading technique that's, well, it's a little different. It's less about complicated formulas and more about just seeing things. It's an idea that suggests a stock's past might just give you a crazy glimpse into its future. Let's see how it works. You know, it doesn't matter if you're a pro on Wall Street or just starting out. Every single trader bumps up against the exact same problem. You just never know for sure what's going to happen next. I mean, this is it, right? This is the whole game. How far is this thing going to run, up or down? And when exactly is it going to turn around? Get these right, and you're golden. But get them wrong, and, well, that can really hurt.
So you gotta wonder, what if there was a way to get a hint? You know, some kind of approach to help you anticipate those turns. Well, that's where this idea of price mirrors comes into play. It's all about looking at charts in a whole new way. Okay, so what in the world is a price mirror? Well, the simplest way to think about it is symmetry. It's when the price action on one side of a chart looks like a mirror image of the other side. Like if you could literally fold the chart in half right down the middle, the patterns would kinda sorta line up.
And here's the thing you've got to understand, and the source material is really clear about this. Price mirrors are a visual skill. This isn't about plugging numbers into a formula or using some complex indicator. It's about training your eye and your imagination to see these potential reflections as they're happening.
Okay, that's the theory. But honestly, it doesn't really click until you see it on a real chart. So let's do that. Let's take a look at a real-world example and see how this actually works. So at first glance, this chart just looks like a bunch of random ups and downs, right? But the idea here is that it's actually packed with these price mirrors. You just have to know what you're looking for.
All right, let's zoom in on the easiest one to spot. See those two valleys on the left, marked A? This is your most basic price mirror. It's what traders call a double bottom. The price hits a low, bounces, comes back down to about the same spot, and bounces again. See the symmetry? It's a perfect little reflection.
So, how would you even spot this as it's happening? Well, it's pretty simple, really. First, you see a low point get established. Then you watch the stock rally and start to fall back down. And here's the key. You're watching to see if it finds support, a new bottom, right around that same price level as the first one.
And this isn't just for bottoms, it works for peaks too. Look at the two peaks labeled B. They seem to be reflecting across that center line G. It's not a perfect mirror image, for sure, but you can definitely see how the shape on the left is roughly mimicked by the shape on the right.
And here's why this matters. The big idea is that if you can spot the left side of a mirror forming, it gives you an educated guess about where the right side might finish. It's like having a potential target for where, and even when, the next big turn might happen.
Okay, hold on. Before you run off and start seeing mirror images in every chart you look at, we've got to pump the brakes. This is absolutely not a crystal ball. So let's talk about why and when this whole thing just falls apart.
And look, the person who came up with this is super honest about it. They say it flat out. Mirrors do not always work. You have to remember that. This is a guide, it's a clue, it's not a guarantee. Check this out. This is a textbook example of a mirror cracking. Based on everything we saw on the left side of that chart, the mirror predicted the price was about to drop. But what actually happened? Whoosh! The stock just blew right past that prediction and kept on climbing. Yeah, this really drives it home, doesn't it? The mirror said down, but the market said, nope, we're going up. It's just a perfect reminder that no matter how good a pattern looks, the market can and will do whatever it wants. And here's another thing. Even when a mirror kinda works, it's almost never perfect. Take a look at this chart. See the valleys at B? They aren't at the same exact price. And even more, look at the timing. The pattern on the right side is all stretched out. It took way longer to form than the one on the left. And that's probably the most important thing to get about these so-called reflections. The two key ingredients, price and time, can get really distorted. The symmetry is almost never going to be picture perfect. So you might be thinking, okay, if they fail and they're usually warped, what's the point? That's a fair question. So let's pull this all together and talk about how you can actually use this idea in a smart way. Look, the right way to think about this is not as some magic system that's going to make you rich. It's just one more tool to put in your chart reading toolbox. It's a creative way to help you eyeball potential areas of support and resistance, those zones where the price might hit a wall or find a floor. All right, so let's boil it down. What are the key takeaways here? First, this idea of mirrors is really the hidden logic behind a lot of classic chart patterns you already know, like double tops or head and shoulders. Second, and this is the big one, it's a visual guide, not a guarantee. And finally, its real power is just helping you make a more educated guess about the when and the where of a potential price turn. You know, this final quote from our source really nails it. This method gives you a roadmap to consider when trading. I love that. It's not the destination, it's not a promise, it's just a map of what could happen. So, in the end, it seems the past really can be a mirror for the future on a stock chart. The real question is, can you train your eyes to see the reflection? Okay, so picture this. A stock that was once the darling of Wall Street just plummets. Your first thought might be, hey, time to buy the dip. But what if that dip isn't a dip at all? What if it's actually the first step off a cliff, the start of a long, painful journey down a massive financial mountain? Today, we are going to break down a pattern that can trap even the sharpest investors. It's called a price mountain. And trust me, understanding this could save you from a very, very costly mistake. Let's dive in. We've all seen it happen, right? A stock is flying high, everyone's talking about it, and then bam, it crashes. Your gut instinct, your brain just screams, it's on sale, this is my chance. But here's the billion-dollar question. Is that really a golden opportunity? Or is it a trap that's about to lock up your money for years to come? So what is it about a falling stock that's just so irresistible? It's human nature, really. Our brains are wired to hunt for a bargain. We see a price that's a tiny fraction of what it used to be, and we can't help but feel like we're outsmarting the market. But as we're about to see, when it comes to stocks, a cheap price tag doesn't always mean you're getting good value. There's this classic investing belief, right? What goes down must come up. It feels right. It's comforting, especially when you're looking at a portfolio that's bleeding red. But, a ton of people learned this the hard way during the dot-com bust of 2000. Sometimes what goes down just keeps on going down, or it stays down for a very long time. So yeah, this whole phenomenon, this pattern on a chart, it actually has a name, and it's a pretty perfect one. I want you to think of a stock's chart like a mountain range. A price mountain is that one peak that just towers over everything else. It's that exhilarating climb to the summit, followed by a terrifying, almost vertical drop on the other side. Yeah, the view from the top was amazing, but the real test isn't getting up there. It's surviving the fall and the incredibly long trek just to get back to where you started. Every price mountain basically tells a story in three parts. First, you've got the climb to point A, the summit. This is the peak, where the hype is off the charts, and it feels like the stock can do no wrong. Then comes Act 2, the sudden, heart-stopping plunge to point B, the bottom of the valley. And finally, Act 3, the long, slow, grinding journey back towards point C, the recovery. That's a journey that, frankly, many stocks never actually finish. And this right here is where that whole buy the dip strategy can just completely fall apart. Because that climb from the valley floor back to the peak, it is almost never as quick as people think it's going to be. This is where the fantasy of getting a bargain slams headfirst into a cold, hard dose of reality. The research on this is crystal clear. The bigger the fall, the longer it takes to climb back. A little stumble off a curb is one thing, right? But a catastrophic fall from the top of a price mountain can leave your money stranded for a very, very long time. Okay, just take a second and look at these numbers. They're kind of staggering. If a stock drops, say, up to 20%, the average recovery is about 2.5 months. Okay, not fun, but you can probably handle it. But watch what happens. The drop gets to 50%. Now you're waiting almost 2 years just to break even. And if it's a massive 90+% collapse, you better pack a lunch, because on average, you are looking at a 12-year wait.
So a little 20% drop, a couple of months. We can call that a dip. You can probably bounce back from that pretty quickly. But an 80 to 90% drop? Whoa. We are not talking about a dip anymore. We're talking about a crater that takes on average 9 years to climb out of. 9 years just to get back to where you started.
So the lesson here is really, really simple. A small drop might be a genuine opportunity, but a massive drop, that could be a financial black hole that just gobbles up your money and your time for a decade or even more. Now, this isn't just a bunch of abstract data. Let's make this real. Let's talk about a company I'm sure you all know, a company that climbed one of the biggest price mountains ever and then fell right off the other side. Take a look at this. This is the stock chart for Intel. Back in the crazy days of the dot-com bubble, Intel was an absolute king. Its stock just went vertical, creating this, well, it's a textbook price mountain. It's almost perfect. And then the bubble popped and Intel stock came tumbling down hard.
So let's just put ourselves in the shoes of an Intel investor back then. It's August 2000, you buy in at the absolute peak, around $76 a share. You're feeling like a genius. Then you just watch in total horror as the stock loses 84% of its value over the next 2 years. You tell yourself, it's Intel, it'll come back. But then, look, by December of 2014, that's 14 years later, the stock is still only at $38. You've waited a decade and a half just to get half of your money back. That is the brutal, brutal reality of a price mountain.
So, okay, after seeing the hard data and the painful real-world consequences, what's the big lesson here? What should you take away from all this? All right, let's nail this down. 3 key takeaways. First, do not get hypnotized by a stock's past glory. Just because it hit some crazy nosebleed level once does not mean it's going back there anytime soon or ever. Second, trying to time the absolute bottom of a crash? It's a fool's game. You're far more likely to get hurt than to get rich. And finally, number 3, if you see a chart that looks like a giant steep mountain, treat it like a giant red flag, a warning sign. It's telling you that your capital could be stuck in limbo for years with absolutely nothing to show for it. I'm going to leave you with this quote that just perfectly nails the danger here. It says that the novice investor looks at a price mountain and bets it can do it again. And you know what? That prediction will probably come true. It just might not happen in your lifetime. So the next time you feel that temptation to buy the dip, just stop and ask yourself, is this a small hill I can easily handle, or am I about to get trapped on the side of a massive mountain with no summit in sight? Answering that question honestly could make all the difference. Thanks for tuning in.
Welcome to The Explainer. Today we're going to break down a classic chart pattern that traders keep a close eye on for clues about a stock's next big move. We are talking about the rectangle pattern, basically a signal that there's a pause in the action right before the fireworks.
So, let's start with something you've probably seen a bunch of times. You're watching a stock, it's been moving, and then it just stops. It's not going up, it's not going down, it just gets stuck, kind of trading back and forth in this tight little horizontal box. So what in the world is going on there?
Well, that sideways shuffle often forms what technical analysts call a rectangle. And you can think of it like a period of consolidation. It's like a big battle between the buyers and the sellers, and neither side can really get the upper hand. The price is just trapped between a floor of support and a ceiling of resistance, building up all this energy for whatever its next big move is going to be.
Okay, let's really get into it. How do you actually tell the difference between a real, legitimate rectangle pattern and just, random sideways noise on a chart? Turns out there are some really specific things you need to look for.
Here we go. This is a perfect example straight from the source material. So you see that sharp run-up? Then at point B, the price goes into this consolidation phase, just bouncing between 2 really clear horizontal lines. That's our rectangle. Then at point C, you see the breakout, where the price just busts right through the top of that box.
Now that little dip back down at D, traders call that a throwback. It's like a quick retest of that old ceiling before it continues its climb.
Now, let's get a little more specific. The source material gives us a super clear checklist to confirm if we're looking at a real rectangle. We need to see at least 5 separate touches of those support and resistance lines, and the whole thing should last for at least 3 weeks. And here's a really interesting detail. 71% of the time, the trading volume actually shrinks during the pattern. It's like everyone's holding their breath, just waiting for a clear signal before they jump in.
All right, so once we've found a valid rectangle, the big question is, which way is it going to break? Up or down? Well, lucky for us, the source data gives us some really powerful stats on what tends to happen.
The numbers show a really clear bullish bias. Based on the study, rectangles break out to the upside 63% of the time. That's almost twice as often as they break down. So even though it's a consolidation pattern, it definitely seems to resolve in the direction of the prior trend more often than not.
And this is where the data gets fascinating, because there's this huge asymmetry in how powerful the moves are. It's not just that upward breakouts are more common, they are way more explosive. The average rise after an upward breakout is a massive 51%. Now compare that to a downward breakout, where the average drop is a much smaller 16%.
But here's where the whole story takes a really interesting twist. See, breakouts aren't a sure thing. Sometimes they fail, or bust. And what happens after a failed breakout? Well, that's one of the most compelling parts of this whole research.
So a bust is when a breakout fails to move more than 10% before it reverses and closes on the other side of the rectangle. Upward breakouts bust about 24% of the time, but look at the downward breakouts. They fail a staggering 43% of the time. That is a huge, huge tell.
So this is super important. When an upward breakout fails, the result can be pretty nasty. The price reverses and falls an average of 23%. This is what traders call a bull trap. It looks like a breakout, but it sucks you in and then turns into a steep drop.
But this right here, this is the most powerful stat of all. When a downward breakout fails, it's not just a failure, it's a launch pad. The stock reverses course and absolutely rockets upward an average of 56%. This bear trap creates an incredibly explosive move to the upside.
So how can we actually use this? Well, this insight into busted patterns isn't just an interesting little fact. It's the foundation of a really powerful, kind of counterintuitive trading strategy that's all about capitalizing on these exact reversals. This chart shows the strategy in action perfectly. You can see the price consolidating in that rectangle, then it breaks down. But notice how shallow that drop is? There's no real momentum. And then it just whips around, reverses course, and not only recovers, but blasts right through the top of the old rectangle. That is the exact signal of a busted downward breakout.
The source actually lays out a clear 4-step setup for this. First, you gotta find a valid rectangle. Then, you watch for that downward breakout that just doesn't follow through. It drops less than 10%. Now, the key trigger, the real signal, is when the price reverses and closes above the high of the entire rectangle pattern. That bust is your signal that the sellers have failed and a powerful move up could be starting.
So what we've really learned today is that with rectangle patterns, the most obvious signal, that first breakout, isn't always the full story. Sometimes the most powerful and profitable message the market is sending is when an expected move fails, and fails spectacularly. It really makes you ask the question, is a failed breakout actually a failure, or is it the real signal in disguise?
You know, in stock trading, there are these rules that just feel like common sense, like the trend is your friend. But what if one of the most common beliefs about trends is actually wrong? Today, we're going to put a really popular trading assumption under the microscope, and believe me, the data tells a very surprising story.
All right, so let's get right to the heart of it. Picture this. A stock is showing a bullish chart pattern, and it breaks out to the upside. Now, which scenario is going to give you a better shot at a big gain? Is it a reversal pattern, where the price has been going down, and then it flips and starts heading up? Or is it a continuation, where an uptrend just kind of takes a breather and then keeps on climbing? Now, if you ask pretty much any trader out there, they're probably going to put their money on continuations. I mean, it just feels intuitive, right? It just seems way easier for a stock to keep moving in the same direction than to slam on the brakes and pull a complete U-turn.
And the thinking behind this is pretty simple, really. With a continuation, you're just flowing with the current. With a reversal, you're trying to swim upstream. Seems pretty obvious which one should be easier. But as we're about to find out, our gut feelings can sometimes lead us way off track.
Yeah, but what if that common wisdom, that gut feeling that we all have, is just plain wrong? This is where things get really, really interesting. Because when we stop guessing and start looking at the cold, hard data from thousands of actual chart patterns, a totally different picture starts to emerge.
Okay, enough with the guesswork. Let's get into the evidence. Here's what the numbers actually say about which of these patterns delivers the biggest gains after a breakout.
And here it is. Bam! The data shows that for upward breakouts, reversal patterns actually do better than continuations. On average, a breakout from a reversal leads to a whopping 47% rise, compared to just 42% for continuations. Now, that 5-point difference might not sound like much, but in trading, that is a huge statistical edge.
This slide really breaks it down for us. See, up top, you've got the reversal. The price trends down, it forms a base, and then it breaks out for that stronger 47% average gain. Then down below, you've got the continuation. The price is already on its way up, it pauses for a bit, and then it keeps going, but for a smaller 42% gain on average.
So, does this mean reversals are always the way to go? Well, not so fast. Just to add a little wrinkle here, when we look at downward breakouts, stocks breaking lower, the whole thing flips. In this case, the common wisdom is actually right. Continuations, where a downtrend just keeps on dropping, lead to a bigger average fall of 18%, versus only 16% for reversals. So the key thing to remember is that this whole reversal outperformance is a special feature of upward breakouts.
Okay, so we've just uncovered a really powerful fact. But to turn this insight into a strategy you can actually use, we've got to go one level deeper. We need to get way more specific about what we mean when we say trend.
I absolutely love this analogy from the source material. Our first finding, that reversals beat continuations, that's like saying, I have a headache. But now we need to figure out what's causing it. Is it just a little tension headache, or is it a full-blown migraine caused by something specific? That's what we're looking for now.
To figure this out, we need to get two types of trends straight. First up, we've got the primary trend. Let's just call it P for short. This is the big picture, the trend over the whole year leading up to the start of the chart pattern. Think of it as the long-term vibe of the stock.
And then there's the second one, the trend from trend start, or TS. This is what's happening right before the pattern forms. It's that immediate sell-off or run-up that leads into the pattern itself. So that gives us the shorter-term context.
Now, when you put these two things together, the long-term P and the short-term Ts, you get 8 different scenarios, and each one has its own unique performance. I know, this looks a little complicated, right? But don't worry, we're about to cut right through the noise and zero in on the one combination that blows all the others away for upward breakouts.
And here it is. This is the absolute sweet spot. The best performing setup you can find for an upward breakout is one that reverses both a downward primary trend and a downward trend from trend start. So when a stock has been beaten down long-term and short-term, and then it breaks out to the upside, that's when you see the biggest average pop, a massive 48%.
So that's the theory, that's the data. Now let's see what this looks like on a real-world chart, and how this can give you a concrete trading edge that you can actually use.
Okay, take a look at this. This is a real chart of a utility company called Ameren. You can see it clear as day, a classic double bottom reversal pattern with two very distinct lows. After that second low, the price just explodes to the upside. So the big question is, does this setup match our perfect high-performance profile?
Let's break it down. Let's run our little checklist. First, is the breakout direction upward? Yes, check. Second, what's the primary trend? Well, if you look back a year from where this pattern started, the price was way higher, so the long-term primary trend is down. Check. And third, what about the trend start? The move right into the pattern was a pretty sharp drop from a recent high, so the short-term trend is also down. Check.
And just like that, bingo! Upward breakout, downward primary trend, and a downward trend from the start. This Ameren chart is a perfect textbook example of the highest probability, best performing setup the data pointed us to, the one with that incredible 48% average gain.
Now look, is any setup a sure thing? Of course not. Trading doesn't work that way. But as the source material so wisely puts it, this is exactly what a statistical edge looks like. And in a game of probabilities like trading, sometimes having that little edge is all you need to put the odds in your favor for the long haul.
So as we wrap this up, it's pretty clear the lesson here is so much bigger than just some little trading trick or rule of thumb. It goes way deeper than that. It's really about the importance of challenging your own assumptions and the common knowledge that everybody else just accepts as fact.
The idea that continuations are always safer or better just feels right, but the data proved it's not nearly that simple. So the real question I want to leave you with is this. What widely held belief in your field, in your career, or even in your life might also be wrong? And what could you discover if you actually dared to go and check the data?
Have you ever had that feeling? You watch a stock you own just slide and slide in this relentless straight line down. It's got to be one of the most nerve-wracking patterns in all of investing. So what is really going on there? And more importantly, what should you do about it? Let's break it down.
So picture this. You've got your money on the line and the chart is doing that. It's not some sudden overnight crash. It's a steady, grinding decline. The billion-dollar question is, right, is this a temporary dip you should be buying, or is this the start of something much, much worse? That's exactly what we're here to figure out.
Okay, so before we can even think about what to do, we have to know exactly what we're looking at. So let's start with a crystal clear definition of this pattern.
So the source material gives this a name, and honestly, it's perfect. A straight line rundown. This isn't some chaotic panic sell-off. Nope. It's a measured, consistent drop where the low points on the chart could almost be connected with a ruler. And it's that very steadiness that makes it so unique and, frankly, so unsettling.
The author, Thomas Bulkowski, he has this fantastic analogy to really make this stick. Think about a vertical run. That's like dropping a stone right off a cliff, just a sudden, terrifying freefall. But our pattern, the straight line run, it's more like rolling that same stone down a long hill. It's got momentum, it's got a steady pace, but it feels more like a controlled descent than a chaotic plunge.
And here is that exact pattern out in the wild on a chart for Biogen. The move from point A down to B is the textbook example. You see that steady pace decline. But here's the kicker. Look what happens after. A full recovery all the way back up to point D. And this right here is our first big clue that these scary-looking drops don't always end in total disaster.
So, if a full recovery is possible, what are the actual odds here? Well, this is where things get interesting. Once you've spotted this pattern, you're basically standing at a critical crossroads.
All right, here's the big headline number from the research. 52% of the time, after one of these runs ends and bounces a little bit, the stock just keeps going down, eventually falling below its recent low. That's right, your odds are slightly worse than a coin toss.
Let's break that down a bit more. You can see the probabilities right here, but the number that should jump out at you is that massive 48% slice. Almost half the time, the stock makes a full recovery. The rest of the time, it only bounces a little before it starts falling again. So you've got this incredible tension. Is it going to snap all the way back, or is it just going to keep digging a deeper hole?
So, how do you trade a coin flip? Well, you don't. You look for an edge, and the research suggests the real secret isn't in the drop itself, but in what the stock was doing before it all began. In other words, and this is key, context is everything.
All right, let's start digging for those clues. First up, what happens when the stock was actually in a healthy uptrend before it started rolling downhill?
So get this, the most common scenario, happening in 39% of cases, is this classic stair-step pattern. The stock moves up, pulls back, moves up again, pulls back again. In this context, the straight line run is just another pullback. When you see this, the bigger picture is generally bullish, suggesting the climb probably isn't over yet.
And here's what that looks like in the real world on a chart for Ball Corp. Take a look at B1, C1, and D. Each one of those is a straight line drop. But when you zoom out, you realize they're just little breathers in a much larger uptrend. And that, spotting that bigger picture, is what can give you the confidence to maybe not hit the panic button.
Okay, the second most common variation, showing up about 23% of the time, is what the author calls the twin peaks. So, the stock hits a high, has a straight line drop, and then rallies right back up to that same high without actually pushing through it. But, and this is the important part, it also doesn't break down below its recent lows.
In this chart of Axis Capital, it's a textbook example. You see those peaks at B1 and D1? Now, usually a double top like that is a bear signal predicting a drop, but in this case, it fails. The price never falls below that low point at C1. It just kind of pauses and then continues its move higher. So in this specific context, a failed bearish signal actually becomes a really powerful bullish clue.
Okay, so that's the optimistic scenario. But what if the stock was already looking weak before the drop? Let's flip the script and check out the clues you'll find when a stock is already in a downtrend.
Now, when a stock is already heading down,
two patterns tend to show up the most. In about 35% of cases, you see a small dip, followed by the straight line run, and then, surprisingly, a really strong recovery. But in 20% of cases, you get that same setup, and the stock just keeps on falling, pretty much confirming its weakness.
And really, this brings us to the #1 takeaway of this whole thing. You cannot look at a straight line drop in isolation. It just doesn't work. Whether it's a healthy little pullback in a strong uptrend or an acceleration of a downtrend, the context leading into the pattern is what gives you the edge you need to beat that 50-50 coin flip. Okay, theory is great, right? But let's put this stuff into practice. We're going to walk through a real-world scenario to see how all this knowledge could help you make a much, much better decision.
So let's imagine you own stock in 3M Company. It's been on an absolute tear, hitting an all-time high up there at point C. But now you're watching it just slide, day after day, down to point D. Your gut is probably screaming at you, right? Sell! Get out! But hold on. Is that really the smart move?
So let's just pause right here for a second. Based on the patterns we just looked at, what does the context of this chart tell you? Does this look like a trend that's over, or maybe one that's just taking a well-deserved breath?
Well, if we step back and actually apply what we've learned, the picture gets a whole lot clearer. The overall trend is definitely up. We don't have twin peaks yet, and it's not some other pattern. This setup most closely matches that bullish stair-step pattern, which, remember, is the most frequent one we see at 39% of cases. The evidence here strongly suggests the upward move probably isn't over. But, and this is a big but, we always have to remember what's at stake. As the author puts it, the other 52% of the time, the stock turns into a stinker and digs a hole. Without looking at the context, you're just gambling. Looking for those patterns that came before the drop is what helps you find the scenarios with the highest probability of success. So the next time you see one of your stocks doing this, that steady, relentless slide downhill, don't just stare at the drop. Zoom out. Look at the trend that came before it, because the answer to what happens next is almost always hidden in what just happened. The only question is, will you spot the clues?
All right, let's talk about a stock chart pattern that I'm sure you've seen. It looks like an absolute dream come true, but, well, it can turn into a real nightmare. We're talking about the straight line run-up. You know the one, that incredible, almost vertical climb that leaves every trader asking one really important question.
Yeah, that one. You see a stock just take off. It's climbing day after day, and it feels completely unstoppable. But deep down, you know it can't go on forever, right? So what's the next move? Is it just going to pause for a breath, or is it about to come crashing back down to earth?
And hey, if you're asking that question, you're in good company. Chart pattern guru Thomas Bulkowski wanted the exact same thing. But here's the difference. Instead of just guessing, he did what he's famous for. He went out and crunched the numbers, he collected the data. And that data is exactly what we're going to get into today.
And this really gets to the heart of the matter. The big dilemma for any trader, right? You're holding one of these rocket stocks. Do you sell, lock in those profits, but maybe miss out on even more upside? Or do you hang on for dear life and risk giving it all back when the music finally stops?
Okay, so first things first. Before we can even start to analyze this pattern, we have to know exactly what we're looking for. How do you actually spot a real, true straight line run in the wild?
Well, it's pretty much what it sounds like. You're on the lookout for a sustained advance, where the price is just consistently moving up, kind of like it's climbing a ladder. The real key here is that it follows a super clear upward trend line with very few, if any, significant dips or pullbacks along the way.
And here we go. This chart shows it perfectly. Just look at the move from point B up to point C. See how those price bars are basically stacked right on top of each other? It almost forms a straight line. That, right there, is the signature of this pattern.
You know, Bulkowski has this great analogy for what's happening psychologically. He says it's like traders are just gobbling up the stock like hungry kids until they're full. Then, all at once, they stop buying. It's a fantastic way to think about it. This isn't just about price. It's pure market FOMO, right? Everyone is rushing in. But eventually, the buyers get stuffed. They stop. And without that constant buying pressure, well, the price has only one way to go, and that's down.
So, okay, the buying stops, the stock hits its peak, and the party's over. Now we get to the million-dollar question, what happens next? And this is where the data gets really, really interesting.
And keep in mind, these insights aren't just one-off stories or guesses. Nope, they're based on a solid study of almost 1,500 real-world examples. So that gives us a pretty powerful statistical look at what usually happens. So after that peak, the price usually pulls back. It retraces part of that big gain it just made. And what the research shows is that it tends to follow one of four main paths, ranging from just a little dip to a complete and total collapse.
And this chart breaks down the odds for us. So about a quarter of the time, the dip is pretty shallow, not too bad. But look at this. The most common outcome, happening 31% of the time, is a moderate retrace. That means it gives back between 38 and 62% of the run-up. But here's the really scary part. In 21% of cases, the stock gives back all of its gains and then keeps on falling. Ouch. So let's focus on a crucial number here. There's a 38% chance of a trend change. Now, what does that actually mean? It means a drop of 20% or more from the peak. Basically, the stock enters its own little bear market. That is a pretty significant risk of a major loss.
But, and this is a big but, here's the other side of that coin. Even with that scary pullback, there's a 79% chance that after the whole retrace is over, the stock will eventually recover and climb up to a brand new high. And that is what makes the decision to sell or to hold on so incredibly difficult.
But, context is everything in the market. The meaning of this pattern can change, and change dramatically, depending on whether it shows up in a bigger market uptrend or a downtrend.
So let's say stock has been getting hammered, just falling and falling, and then suddenly it goes on one of these straight line runs. That's a huge signal, but it could be signaling one of two totally different outcomes. Most of the time, we're talking 77% of cases, this pattern actually signals that the bear market is over and a new bull run is starting. It's that explosive move right off the bottom. But in 13% of cases, it's a trap. It's just a quick little relief rally before the stock resumes its downward spiral.
Okay, now what if the pattern shows up when a stock is already in a nice established uptrend? Well, it's usually a lot less dramatic. In about 78% of those cases, it's just a temporary burst of speed. The stock has its run, it pulls back a little, and then it just keeps on heading higher. But in those other cases, that little pullback turns into a much, much deeper correction.
And this brings us to what might be the single most important warning sign to watch for. If the price falls and then closes below where that whole run began, the data is crystal clear. That is a powerful signal to seriously consider selling. The upward momentum is completely broken at that point.
So, we know how to spot the pattern, and we know the odds. The question is, how do we take all this knowledge and turn it into a practical trading strategy? Well, for short-term traders, the source suggests a really simple visual approach. Step 1, identify the run. That's easy enough. Step 2, you draw a trend line. That's just a straight line connecting the lowest price points of the run. Think of this line as its immediate upward momentum. And then, step 3, your potential sell signal comes when the price actually closes below that line.
And here's a chart showing it in action. See? You draw the trend line from A to B, and look, the price breaks below that line pretty soon after the peak. Now, are you going to sell at the absolute tippy top? No, of course not. Nobody ever does. But a method like this can help you capture the lion's share of the gains and get you out before things get really ugly.
So the next time you see a stock going parabolic, you're going to be armed with a lot more than just hope. You'll actually understand the psychology behind it, you'll know the probabilities of what comes next, and you'll have a clear, simple signal to watch for. The only question left is, how are you going to trade it?
What if one of the simplest patterns on a stock chart, something you literally see every single day, held a powerful, data-backed secret to predicting market moves? Well, we're about to find out if a little piece of old market wisdom is actually a trader's hidden edge. So where did this whole thing come from? It all started with this piece of market folklore, a casual comment that ended up sparking this huge data-driven investigation by an author named Thomas Bulkowski. The idea was simple. Bottoms are usually V-shaped and tops are rounded. I mean, come on, that sounds way too simple to be true, right? And that's the big question we're tackling today. Is this just some old saying, an old wives' tale for traders? Or is there a real, actual statistical edge hidden in the shape of a market turn? We're going to dig into the data and see what we find. Okay, so let's get into it. Our journey starts by taking this casual observation and turning it into something we can actually test. I mean, how do you even begin to prove something like this? Yeah, when you look at them side by side, the difference is, well, it's pretty obvious, right? You've got this sharp, aggressive V-shaped turn, and then you have this slow, kind of meandering, rounded one. They look totally different. But here's the multi-million-dollar question. Do they act differently? Do they perform differently after the turn is in? All right, so to actually analyze this, we've got to have some clear definitions. We're going to call the V-shape a narrow turn. Think of it as quick, sharp, decisive. And the other one, that's a wide turn, slow, gradual, rounded. These are the two key ideas we're going to be measuring. Okay, but how do you actually measure something like a V-shape? I mean, that's a subjective visual idea. How do you turn that into cold, hard, objective data? Well, you need a scientific method. And the one the author came up with is it's pretty clever. So here's the heart of it. To measure how wide a peak is, the author created this consistent reference point. He finds the absolute highest point of the peak, and then he draws a line exactly 5% below it. The points where the price crosses that line, once on the way up and again on the way down, that's what defines the width of the turn. Simple, but effective. So the whole process really just boils down to 3 simple steps. First, you find a major peak or valley. Second, you find those points on each side that are 5% away from that high or low point. And third, you just count the trading days, the bars, between those 2 points. And boom, that number. That's your width. And get this wasn't some tiny little study. To really test this idea, the author applied this exact method to over 51,000 market turns. That is a huge data set. We're talking about results that have some serious statistical weight behind them. Okay, so the method is solid, the data set is massive. So what did the numbers actually say? What did the data reveal? This is where it gets really interesting. First up, let's talk about market tops. And honestly, the data was crystal clear on this. After one of those narrow V-shaped tops, the median decline was a big one, 20%. But after a wide rounded top, the drop was only 12%. Think about that. That's an 8 percentage point difference in performance just based on the shape. Okay, that's pretty cool. But now, check out the market bottoms. Because here, the effect is even more dramatic. A narrow V-shaped bottom was followed by a median rise of a whopping 40%. Compare that to the wide, rounded bottom, which only saw a 26% rise. So the V-shape, it's clearly signaling a much more powerful, more explosive move to the upside. So here's the bottom line. The crucial point is this. The data proves flat out that the narrower the turn, doesn't matter if it's a top or a bottom, the more powerful and explosive the move that comes after it. That old piece of market folklore? Turns out, it was dead on. But wait, there's more. We can actually make this insight even more powerful. What happens when we add another classic layer of analysis into the mix? Let's bring in the primary market trend. So what's the primary trend? It's really simple. It's just the stock's general direction over the past year. Now, a turn that goes with that trend, we call that a continuation. A turn that goes against it, that's a reversal. And this context, as you're about to see, is absolutely crucial. Okay, now we can put the whole puzzle together. By combining the shape of the turn, narrow or wide, with the primary trend, reversal or continuation, we can start to forecast performance with even more accuracy. So let's break down the best and worst combinations. All right, let's start with the bottoms. The data shows a clear winner here. Just look at the chart. That tall bar on the left, that's the absolute best case scenario. It's a narrow V-shaped valley that reverses a year-long downtrend. That combination led to a massive 43% median rise. Now, compare that to the worst performer over on the right. A wide, rounded bottom that's just continuing an existing uptrend. That only got you a 25% pop. And what about the tops, the most powerful signal to sell? That's a narrow peak that continues an existing downtrend. See that bar on the left? That led to a 20% median drop. And the weakest signal? Over on the far right, that was a wide, rounded peak that was trying to reverse a strong uptrend. It only fell about 12%. Okay, so this is a ton of data, right? So the big question is, how do we turn all of this into simple, actionable rules that a trader can actually use? Let's get practical. All right, let's look at a real-world example from the book. So here we have a stock that's forming a peak. Now, if we draw our 5% line, we can see really clearly that there are a lot of days inside that width. It's a classic, wide, rounded peak. And based on everything we've just learned, our data suggests a smaller than expected decline is probably on the way. So this entire analysis really boils down to 3 simple rules. Rule 1, if you see a wide, rounded peak, the odds say the decline will be small, so maybe you hold on. Rule 2, if you see a sharp, narrow V peak, get ready for a much larger drop. And rule 3, on the flip side, those sharp V-shaped bottoms, those are the ones that signal the strongest rallies. And this right here is the key takeaway from all of this. Look,
This is not a crystal ball. It's not about being right 100% of the time. Nothing in trading is. It's all about understanding the probabilities. The shape of a turn gives you a statistical edge. And in the world of trading, an edge, well, an edge is everything. So, I'm going to leave you with this question. The next time you're looking at a chart and you see one of those really sharp V-shaped bottoms or one of those slow, meandering, rounded tops, will you look at it differently now? Because all the data we just went through suggests you probably should.
You know that feeling, right? The whole market's on fire, everything's green, except the one stock you own. It's so frustrating. It feels like that stock is trying to tell you something. But what? Well, today, we're going to decode those exact signals.
You know, this gets right to the heart of a puzzle that the author of our source material, Thomas Bulkowski, once faced. And really, it's a puzzle every investor runs into. You see this massive, clear trend in the market, but your stock is doing the complete opposite. Your gut is screaming that something is wrong, but is it right?
So yeah, that's the big question we're digging into today. When a stock just refuses to go along with the market, what is it trying to tell us? Is it a huge warning sign, a reason to get out now? Or could it actually be a hidden signal of incredible strength? It turns out the answer is, well, it's both. And knowing the difference, that's the whole ballgame.
Okay, so to solve this puzzle, we've got to get our tools straight. We first need to understand the two main ways a stock can act when you compare it to the overall market. So let's break down these two big ideas, trend versus countertrend. All right, think of it like this. Imagine the market index. Say the S&P 500 is a big river. The current is flowing in one direction. Trend followers, they're simple. They're the stocks swimming with the current. If the river's moving north, they're heading north too. Easy peasy. But then you've got the countertrend stocks. These are the rebels. They're the ones trying to swim against the current. Now think about that. When the entire river is pushing one way and something is fighting to go the other way, well, that either takes some serious, incredible strength or it means it's in big trouble.
So this chart here maps out these behaviors over a whole year, and it gives us these four, let's call them market personas. First up, you've got your trend followers. You've got the bullish ones that rise when the market rises, and the bearish ones that fall when the market falls. Pretty straightforward, right? They just go with the flow. But then you have the interesting ones, the counter trends. The bearish counter trend stock is the one that actually falls even when the market is having a great day. And the bullish counter trend, that's the one that rises even when the whole market is tanking. Now, I want you to really focus on these two counter trend groups because they are the key to unlocking this whole thing. All right, let's start with the bad news first. Let's talk about that negative signal, the one that gave our author that gut-sinking feeling all those years ago. What exactly is happening when a stock just drops on a day when everyone else seems to be making money? This, my friends, is the warning sign. And here's the official name for that feeling, a bearish countertrend. It's when the S&P 500 has a really strong day. We're talking up 1% or more, but your stock somehow ends up in the red. It's actively fighting against a really powerful upward push. And here it is, the first major takeaway from the research. You want to avoid stocks that fall on a strong market day. It's just a massive red flag. The data is pretty overwhelming on this. It's a sign of some kind of internal weakness, a clear warning that it's probably going to underperform. It's one of those signals you really need to listen to. And look, it's not just about one bad day. It's the pattern that really tells the story. This table lays it all out. The more often a stock fights a rising market, the worse it tends to do a year later. Just look at the difference here. Stocks that had zero of these weird moves, they gained over 21% on average. But the ones that did it 8 or more times in a month? Oof, they barely managed to clear 16%. Let me just put that into perspective for you. A stock that repeatedly shows this weakness, falling when everything else is rising, underperforms a normal stock by more than 20% over the next year. That is a huge performance gap, and all it takes is paying attention to this one simple signal. So let's go all the way back to our opening story. That gut feeling the author had? You know what? It was dead on. The data completely backs him up. His instinct to steer clear of that stock was absolutely the right call. But that's only half the puzzle. What about the stocks that fight the market in the other direction? Okay, so let's completely flip the script. If fighting a rising market is a bad sign, what about fighting a falling one?
This is where it gets really, really interesting, because this is where we find what the research calls the moonshot signal.
I absolutely love this quote from the source material. It just perfectly captures the feeling of this discovery. While everyone else is panicking on a big down day, there are these select few stocks that aren't just holding their ground, they are actually gaining. And those are the ones that can go on to produce just spectacular results.
So what are we looking for? It's the exact mirror image of our warning sign. We're looking for one of those days where the S&P 500 gets hammered, closing down 1% or more. A bullish countertrend stock is one that, on that exact same day, ends up in the green. It's showing just incredible relative strength when everyone else is weak.
And boom, here's the payoff. Just look at this chart. 1 year after a big market drop, the index itself bounced back to gain about 13%. Not bad. The stocks that just fell with the market, the trend followers, they did even better, gaining almost 20%. But the bullish countertrends, the ones that stood tall on that awful day, they posted a median gain of over 25%. That is nearly double the index's performance. Just incredible.
And just like with the warning sign, this isn't about a fluke, a single good day. The real magic happens when you find stocks that do this consistently. A pattern of strength is an even stronger signal than a one-off event.
And this is where it gets just mind-blowing. The effect actually compounds. A stock that shows this strength just twice in a month already starts to outperform. But look what happens when it happens 8 or more times. A staggering 35.3% median gain over the next year. It's pretty clear. The more a stock proves it can defy a downturn, the stronger its future performance looks.
So what's the bottom line here? What does this all mean for you? How can we turn these amazing findings into something you can actually use, a new lens for looking at the market? Let's boil it all down into a clear, actionable plan.
Okay, so here's a simple 4-step process for spotting this incredible setup. Number 1, you wait for the trigger, a bad day for the S&P 500, down at least 1%. 2, you go on the hunt for the outliers, the stocks that actually closed up on that day. 3, you do a little homework. Look at the past month. Is this a one-time thing or is it a pattern? And 4, the research suggests that the more times you see it happen, the better the signal for great performance over the next year.
All right, let's wrap this up with the key takeaways. First, a stock falling on a strong market day, that's a huge warning sign. Second, a stock rising on a weak market day, that is a powerful signal. The key is that strength against the current is what reveals the hidden winners. And this leads to a really cool idea. The market's absolute worst days might actually be a gift, pointing you to the best opportunities.
So we'll leave you with this question to chew on. We're all taught to be afraid of market downturns, right? To panic. But what if we completely reframe that? What if those big, scary red days weren't a reason to run and hide, but were actually your best opportunity to scout for the next big winners? Based on this research, that might just be the smartest move you could possibly make.
Have you ever come across an idea in stock charting that sounds, well, a little too good to be true? Something that feels almost like magic? Today, we're digging into one of those. A fascinating and, kind of strange technique called the triangle apex turn. It claims to use simple geometry to predict a specific date when a stock's price might just turn on a dime.
You know, this quote from Thomas Bulkowski really says it all. This is the guy who literally wrote the encyclopedia on chart patterns. And he calls this technique one of those ideas that's hard to believe, but he found it actually works. When an expert like that says something that piques his own skepticism, you've got to lean in and listen.
So, that's the big question we're tackling, right? Can two simple lines drawn on a chart really converge to pinpoint a future turning point for a stock's price? It sounds a bit like reading tea leaves, but we're going to break down the theory, look at the evidence, and see what the data actually says.
All right, so what we're looking at is a very specific thing called the apex turn. It's tied directly to one of the most common chart patterns you'll ever see, the triangle. The wild idea here is that the very shape of the triangle itself holds a secret clue about what's coming next.
To really get our heads around this, we need to break it down into 2 simple parts. First, what exactly is a triangle pattern on a chart? And second, what is this apex and why on earth should we care about it?
So a triangle pattern shows up when a stock's price is getting squeezed into a tighter and tighter range. You can literally see the price swings getting smaller as the highs and the lows start to converge. They come in 3 main flavors: ascending, which has a flat top and a rising bottom; descending with a flat bottom and a falling top, and symmetrical where both lines are closing in on each other like a funnel.
So how do you spot one in the wild? Well, you start by looking for that narrowing price action. Then you just play connect the dots, draw a line connecting the peaks and another line connecting the valleys. Now, for the pattern to be considered legit, the price needs to touch these lines at least 5 times total. That shows that, yeah, the market is actually respecting these boundaries.
And now for the really cool part, the apex. If you just extend those 2 trend lines you drew out into the future, they're eventually going to cross, right? That intersection point is the apex. And this is the most important thing to get. The apex represents a specific point in time, a future date on your calendar, not a specific price level.
And that brings the whole idea together. The theory of the apex turn is just this. As time moves forward and the stock's price action gets to the calendar date of that apex, something interesting is supposed to happen. The price is expected to hit a short-term peak or a valley. In other words, make a turn right around that specific date.
Okay, that all sounds great in theory. But does this stuff actually happen in the real world? Let's check out a couple of real-world examples from the source material and see this thing in action.
First up, let's look at a textbook example where the apex turn just seems to work perfectly. We're looking at a chart of the insurance company AFLAC.
Okay, check out this chart. You can clearly see that symmetrical triangle forming at point A. The 2 trend lines are drawn, and you see them meeting out in the future at the apex, which is marked as B. Now just watch what the price does. It breaks out, it climbs, and then bam, it forms a major peak at point C, almost perfectly lined up vertically with the apex date at B. It's a brilliant illustration of the theory. Right after hitting that peak, the price reverses and takes a nosedive. Now hold on. Before you run off and start drawing triangles on every chart you can find, you have to know this is not a magic bullet. Not even close. Like any tool in technical analysis, it doesn't work every single time. It can and it absolutely does fail. So for a quick reality check, let's look at a chart for air products. This is a case where the apex turn theory just completely fell flat on its face. And you know what? This example is just as important as the one that worked. So here we've got an ascending triangle at point A. The price actually breaks downward, which is a little unusual for this pattern, but hey, it happens. Now follow the price as it moves toward that apex date at B. The theory says we should see some kind of turn here, maybe a minor low, but we get nothing. The stock just keeps on sliding right through the apex date without so much as a pause. This is a crystal clear failure of the method. So we've got one example where it worked like a charm and one where it was a total dud. That's not very helpful for a trader, is it? The real question is, how reliable is this thing overall? Let's move past the stories and look at what the actual numbers say.
In a visual test of 221 valid triangles, the source's author found that the technique worked about 75% of the time. Now, worked in this case meant a noticeable peak or valley formed within a few days of the apex date. I mean, a 75% success rate for a simple visual pattern, that's pretty high. It definitely makes you take a second look.
To get even more granular, a much larger automated study was done on over 6,800 triangles. And it found that the median distance between the apex date and the nearest price turn was just 3 price bars. So if you're looking at a daily chart, that means half of all the turns happened within just 3 days of the apex. That's incredibly close.
And this chart breaks down that timing even further. It shows that 37% of the time, the turn happens within just 1 day of the apex. That jumps to 57% within 3 days, and a whopping 80% of all turns happened within 6 days of that apex date. This gives traders a really specific statistical window to watch for a potential move.
Okay, so we've got a technique that seems to have a real statistical edge, but we know it's not perfect. So how can a trader actually use this information in a practical, real-world way?
The source material uses this great analogy. Think of the market as having waves and a tide. This technique is really for traders who play the waves, the short-term ups and downs. A swing trader or a day trader can use the apex date to help time an exit or maybe even a quick entry. But for long-term investors, they're focused on the overall tide. These minor turns are mostly just noise, so this tool has very limited use for them.
So what's the bottom line here? First, the apex turn is not predicting some massive earth-shattering trend reversal. It's just hinting at a potential short-term turn, usually within a few days of that apex date.
Second, its accuracy depends completely on how carefully you draw your trend lines. Seriously, garbage in, garbage out. The best way to think of it is as one more piece of supporting evidence in your trading toolkit, not as a standalone signal to buy or sell.
So there you have it. A simple triangle on a stock chart might just hold a little secret about its own future. A date circled on the calendar where things could get very interesting. It's a fascinating mix of geometry and market psychology. The real question now is, armed with this knowledge, where will you spot the next one?
Today, we're jumping into one of the most famous patterns in all of technical analysis, the ascending triangle. Now, you've probably heard it's a super reliable bullish signal, right? But what if I told you its biggest strength is actually hidden in its failures? That's right. So let's pull back the curtain on this classic pattern and find the hidden opportunity that most traders completely miss. So, we're diving into the work of Thomas Bulkowski, who literally wrote the book on chart patterns. It's like the encyclopedia for traders. And he kicks off his chapter on ascending triangles with, believe it or not, a confession. He thought he'd found the golden ticket, a sure thing. But instead, he found a trap. And that's exactly where we're going to start, understanding why this pattern is just so darn tricky. And here it is. This is the number that just blows the whole thing wide open. Bulkowski's research found a 16% failure rate for ascending triangles. And just so we're clear, a failure here means the breakout doesn't even make it 5% in the right direction. Now you have to understand, most other classic patterns have failure rates in the low single digits. 16%? That's a huge outlier. It's screaming at us that there's something else going on here.
Okay, so before we can start exploiting this pattern's flaws, we have to be absolutely sure we're seeing the real deal. Getting the identification right is step one, and it's absolutely critical. So let's break down the anatomy of a proper setup. You've got a few key things to look for. First, you need a nice, flat, horizontal top. That's a clear line of resistance where sellers just keep showing up. Second, you need a rising bottom trend line, showing that the buyers are getting more and more aggressive. Third, and this one's a biggie, you need at least 5 total touches on these two lines combined. And finally, you want to see the price action fill out the white space of the pattern, bouncing back and forth as that range gets tighter and tighter.
And this chart right here, it's a perfect example. We've got our flat top at line AB, we've got that clear up-sloping bottom, and let's even count the touches. 1, 2, 3 on top, and 1, 2, 3 on the bottom. That's 6, plenty. And you see how the price swings back and forth, really filling that space? Yeah, that is textbook.
All right, so now we know how to spot one in a wild. But now, let's get to the twist. Because the real story, and frankly, the most exciting trading opportunity, isn't in the successful breakouts everyone's waiting for. Nope, it's in the ones that go spectacularly wrong. First off, let's be fair. The conventional wisdom isn't totally wrong. The data does show the pattern has a bullish bias. About 64% of the time, the price does break out to the upside. And that's exactly why you always hear it called a bullish continuation pattern. But, that number, it only tells about half the story. You gotta love this analogy from Bulkowski. He says they're like helium balloons. See, a throwback is when a stock breaks out, but then it immediately drops back down to test that old resistance line before, hopefully, bouncing off it as new support. This happens a whopping 61% of the time, and it tends to slow things down. The ones that just break out and go, the helium balloons, those are the real winners.
Okay, this brings us to a really crucial idea, the busted pattern. Now, this is way more dramatic than a simple throwback. A pattern gets busted when it breaks out one way, fails to gain any real traction, less than 10%, and then completely reverses, crashing all the way through to the other side of the triangle. It's a total head fake.
So let's compare what happens when a stock breaks out upward from the triangle. It busts about 28% of the time, which, is pretty significant. But now, look at the other side. When this supposedly bullish pattern breaks down, it busts, meaning the downward move fails and reverses back up, an incredible 44% of the time.
Let's just pause on that for a second. 44%. That means that almost half of all the downward breakouts from this bullish pattern are fakeouts. They are textbook bear traps designed to shake everyone out right before the stock turns around and rockets higher. This is the flaw, and this is what we can exploit.
And here it is, the financial punchline. When an upward breakout busts, the average drop is a pretty painful 25%. But when a downward breakout busts and reverses higher, the average rise is a massive 49%. This is where it all becomes crystal clear, right?
The potential reward for spotting one of these false downward moves is almost double the risk of getting caught on the wrong side of a false upward one.
So, the big question, how do we actually make money with this? Let's turn this awesome statistical insights into a concrete strategy. This is where we build a real, actionable, and kind of counterintuitive playbook for trading the triangle's flaws. So here it is, our first setup. Let's call it the busted play. And the core idea is beautifully simple. We stop trying to guess the breakout direction. Instead, we're going to wait for the pattern to break down, and then we're going to pounce when that breakdown fails.
Here's the playbook, step by step. 1. Find a valid triangle using our rules. 2. Do absolutely nothing. Just wait for a downward breakout. 3. Watch for that move to fail. It drops, but not more than 10%, and then it starts rallying back. The buy signal triggers the moment the price closes above the original flat top of the triangle. That's it. That's when the pattern is officially busted. Then you just place your stop loss below the recent low and you're in the trade.
And here's what it looks like on a real chart. We've got our triangle at B1. Then, right here at C1, we see this tiny little downward breakout. Bulkowski actually calls it a nubbin, which is great, and it only lasts for a single day. Then whoosh, right back up it goes, eventually closing above the top of the pattern. That's your buy signal. And the result on this one? A 45% gain. That is the busted pattern setup in all its glory.
Okay, so that's the counterintuitive play, but what about the traditional trade? What if you still want to bet on the good old-fashioned upward breakout? Well, Bulkowski's data gives us a huge edge here too. It shows us exactly how to spot the ones most likely to turn into those high-flying helium balloons.
It turns out the key factor is how old the trend is before the triangle even starts to form. And the data here is just striking. When a triangle shows up in a trend that's 6 months old or less, the average gain after a breakout is a staggering 87%. But if the trend is already old and mature, over 6 months, that gain plummets to just 51%. So the lesson couldn't be clearer. You want to focus on the patterns that pop up early in a new trend.
All right, we've covered a ton of ground, gone through the data, the stats, and the strategies. So let's boil all of this down into a few key, actionable takeaways that you can actually use.
So if you remember anything from this, remember this. 1. Ascending triangles are nowhere near as foolproof as they seem. They have that high 16% failure rate. 2. Their biggest flaw, that tendency for downward breakouts to fail, is actually their greatest strength for us. Just remember that 44% bust rate that leads to a 49% average pop. And finally, if you are going to trade a normal upward breakout, stack the odds in your favor by focusing on patterns that form in the first 6 months of a brand new trend.
You know, this whole analysis really flips the script on a super common chart pattern, and it really makes you wonder, right? What other widely accepted rules of trading are maybe just myths waiting to be busted by data? It's a great reminder to always question the conventional wisdom and just look for the real story the numbers are telling you. If you spend any time at all looking at charts, you've definitely seen this pattern, the descending triangle. It's one of the first ones everybody learns, and it almost always comes with this big warning label. Beware, bearish. But what if that warning label is just wrong? In this explainer, we're going to dig into the real data behind this classic pattern, and, well, what the numbers reveal might just change the way you see it forever.
And here it is, right? In its simplest form. You've got a series of lower highs making that downward sloping ceiling, and it's all pushing down against a flat floor of support. I mean, the conventional wisdom practically screams from the textbook pages, sellers are in control, that floor is about to crack. It's taught as this super clear signal of an impending drop. But is that really the whole story? And then you see a quote like this. This comes from Thomas Bulkowski, who has done some of the most, and I mean the most, extensive statistical analysis on chart patterns ever. And he's telling us flat out that the most powerful move from this supposedly bearish pattern is actually up. Wild, right? This one idea is exactly why we have to look past those old definitions and see what the numbers really have to say.
But first things first, before we can even think about trading this thing, we need to be absolutely positive we're looking at the real deal. You see, proper identification is everything, because a lot of patterns that kind of look like descending triangles just aren't. So let's break down the strict rules for spotting a valid one.
Think of this as your 5-point inspection. First, you've got to have that clean, downsloping trend line connecting the peaks. Second, the bottom has to be a solid horizontal line of support connecting the valleys. Third, and this one is so important,
You need at least 5 distinct touches on those trend lines, not just price grazing by, but real touches. Fourth, look at the price action. It should be filling out most of the triangle. If you see a huge empty gap in there, it's probably not a valid pattern. And finally, number 5, check the volume. It should generally be drawing up as the pattern forms, kind of like a spring coiling up energy right before it's released.
And check this out. This chart just perfectly illustrates all 5 of those rules in action. See the downsloping top line? Clearly defined by points 1 and 2. The horizontal support at the bottom is unmistakable, with solid touches at points 3, 4, and 5. So boom, there's our 5-touch minimum. You can also see how the price just bounces back and forth, filling up that space. And then look at the volume bars at B. They're generally getting smaller right into the breakout at point A. This, right here, is a textbook valid descending triangle.
Okay, so now that we know how to spot one with confidence, let's get past all the assumptions and the old wives' tales. It's time to look at the cold, hard data on how these patterns actually perform, especially in a bull market.
This one slide right here completely dismantles the whole bearish pattern myth. I mean, look at that. In a bull market, the breakout direction is almost a coin toss. 53% of the time it breaks up, 47% of the time it breaks down. So to call this a reliably bearish pattern is just, statistically, it's not accurate. Based on direction alone, it's basically neutral.
But this is where the story gets really juicy. Because not all breakouts are created equal. This shows the power behind those moves. The average gain after an upward breakout is a massive plus 44%. The average drop after a downward breakout, just 16%. So yeah, the direction might be a coin toss, but the potential profit or loss, not even close. The upward moves are nearly 3 times more powerful. This data is exactly why Bulkowski says upward is the direction they work best.
Just a quick but really important point on what happens right after that initial breakout. More than half the time, the price will actually come back to retest the trend line it just broke through. If it was an upward break, we call this a throwback. If it was a downward break, it's a pullback. The key is, don't let this shake you out of a good trade. It's perfectly normal behavior, and, it can actually be a great second chance to get in.
So if the pattern isn't reliably bearish, and the upside moves are way stronger, where's the best opportunity? Well, now we get to look at the author's absolute favorite way to trade this pattern. It's a setup that brilliantly takes advantage of the market faking out everyone who still believes that old textbook definition. It's called the busted pattern.
So what exactly is a busted pattern? It's when the price breaks out to the downside just like everyone expects it to, but the move has no real oomph. It travels less than 10%, and then it just stalls out, reverses, and blasts right through the other side of the triangle. It's a classic head fake. It traps all the traders who bet on the textbook downward move, and it's their panic to cover their positions that fuels that huge reversal.
This diagram shows the trap being set perfectly. The price breaks down at point A, and that lures all the short sellers into the market thinking the floor just gave way. It finds a little temporary bottom at B, but there's no follow-through selling. Then, bam, the buyers step in with force. The price not only gets back inside the triangle, but reverses so powerfully that it breaks out above the top, past point C. This traps all those short sellers and can fuel an absolutely explosive move higher.
And you might think this is some rare, once-in-a-blue-moon event. It's not. According to the data, a full 41% of all downward breakouts from these triangles end up being fakes. They bust. This happens nearly half the time, which makes it a recurring and, a highly tradable setup.
So what's the reward for being patient and spotting this fake out? Well, the average rise after a single downward breakout busts is a staggering 56%. 56. By waiting for that supposed bearish breakout to fail, you can position yourself for a move that's even more powerful than a standard upward breakout from the start.
So how do you actually trade it? Here's the playbook. First, use our 5 rules to make sure you've got a valid pattern. Second, you gotta have the patience to wait for that downward breakout to happen. Third, verify that it's a weak move, a drop of less than 10%. Fourth, and this is your trigger, wait for the price to reverse course, and this is crucial, get a daily close above the highest peak of the entire triangle. That's your buy signal. You can get in on that close or the next morning's open with a protective stop loss placed just below the low point of the pattern.
Okay, you ready to take it up a notch? Let's look at one final setup that combines the power of this pattern with an incredibly bullish market context. This is where truly explosive, portfolio-changing moves can happen.
The idea here is to find a descending triangle that's forming as a consolidation, right underneath a major resistance level, specifically an all-time high.
Look at this chart of Biogen. The all-time high is at A1. The stock then pulls back and forms our triangle at B1, just coiling up and building energy. When it finally breaks out, it not only clears the triangle, but it also punches through that all-time high into what traders call blue sky territory. With no prior sellers or resistance overhead, the run to C1 can be absolutely massive. This is a seriously powerful setup.
But can we refine this setup even more? Oh yeah, the data says we can. Performance varies dramatically based on how long the trend was leading into the triangle. If the uptrend right before it was relatively short, 6 months or less, the average gain after the breakout is a mind-blowing 87%. 87%! If the trend was longer than that, the performance gets cut almost in half, down to a still very respectable 46%.
So the takeaway here is crystal clear. The absolute sweet spot, the A+ setup, is a descending triangle that forms pretty quickly after a new trend begins, right underneath its all-time high. This pattern acts as the perfect launch pad for the next major leg up.
All right, we've covered a ton of ground and busted some major myths today. So let's just boil all of this down into the most important points you need to remember next time you spot this pattern on a chart.
Here are your key takeaways. Number 1, forget the bearish label. The breakout direction is nearly 50-50, and the upward moves are way more powerful. Number 2, the real money is in the busted pattern. Learn to spot that fake downward move that reverses, because it signals a potential 56% rally. And finally, number 3, if you want to hunt for those truly explosive gains, look for these triangles that form quickly, right below an all-time high.
And that really brings us to the end. We've seen how digging into the actual numbers can completely shatter our perspective on a common pattern. It really leaves us with a final question for you. Now that you know the truth about the descending triangle, what other piece of common trading wisdom are you going to question next?
You see symmetrical triangles everywhere on a chart, right? The price gets squeezed between two converging lines, building up all this tension until, bam, a breakout. But here's the question. Is that breakout the real deal, or is it a trap, just waiting to snap shut on your account? Okay, let's get into it and figure this out.
And look, the stakes here are crazy high. As the source material for this whole explainer puts it, getting this pattern wrong can absolutely wreck you. A trader just freezes, they don't know what to do, and bam, they become roadkill. We are not going to let that happen.
So that is the million-dollar question, isn't it? It's not enough to just spot the triangle. You have to understand how it behaves statistically and have a rock-solid plan. And that's exactly what we're going to build right now, using the hard data from our source.
Now, when you first see it, the pattern seems pretty straightforward, just a tightening coil of price. But that's where it gets you. Its simplicity is totally deceptive. The real story, the one that matters, is in the numbers of what happens after the price breaks out.
Okay, so before we can even think about trading it, we have to be 100% sure we've identified it correctly. So let's break down the exact anatomy of a valid symmetrical triangle. The easiest way to think about this is like a tug of war between buyers and sellers where nobody's winning, at least not yet. You've got buyers pushing prices up from a rising trend line, and you've got sellers shoving them down from a falling trend line. And they're just squeezing the price into a tighter and tighter corner.
And here we go. Check this out. This chart is a perfect real-world example. You can see it clear as day, the upper trend line sloping down, the lower one sloping up. And see how the price bounces between them, touching each line again and again? That coiling action is what builds up all the potential energy for the big move later.
So here's a checklist you can actually use. This isn't just about what looks right. You need at least 5 total touches on those trend lines. The price should fill up that empty space inside the triangle, no huge gaps. And this is important. The pattern should take more than 3 weeks to form. Oh, and 83% of the time, you'll see volume just dry up as the pattern gets tighter.
All right, so now we know how to spot one. Let's get to the fun part, the statistical reality of actually trading them. Because honestly, this is where most traders go completely wrong. They see a breakout, they get excited, and they jump in without even thinking about the odds. Now, at first glance, the data seems to give you a bit of an edge. In a bull market, the price pops to the upside 61% of the time. So you're thinking, okay, I'll just bet on it going up. A lot of traders stop their analysis right there, and believe me, that is a huge mistake.
Yeah, because that first breakout, it's very often a head fake. It's designed to either trick you into a bad trade or scare you out of a good one.
right before the real move starts. And the numbers absolutely prove it. More than half the time, right after the breakout, the price snaps back to kiss that trend line it just broke goodbye. Just imagine, you buy an upward breakout, you're feeling good, and then you watch all your profits vanish as the price drops right back to your entry. What do most people do? They panic sell. Usually, right before the move actually takes off for good.
And here it is. This might be the most important number in this whole explainer, 46%. That's the percentage of downward breakouts that completely, utterly fail. The price breaks down, it sucks in all the short sellers, drops just a tiny bit, and then it violently reverses and rips straight through the top of the pattern. The source material calls this a ding-ding-ding moment for a reason. Shorting this pattern is playing with fire.
So, with all these traps and fakeouts and statistical landmines, how in the world are we supposed to trade this thing? Well, we use the data to flip the odds in our favor. Let's look at 3 specific, actionable setups that come directly from the numbers we just talked about. So the first setup, and this is probably my favorite, is where we actually trade against that failed downward move. We use that massive 46% failure rate as our personal invitation to get in. Okay, let's walk through this on the chart. See that downward breakout? It looks pretty convincing at first, doesn't it? But notice the follow-through is just weak. It doesn't drop more than 10%. And then there's the reversal. The price just rockets back up and closes above the highest high of the entire triangle. That right there, that's our trigger.
So this boils down to a super clear, step-by-step plan. No guesswork. You find the pattern, you wait for that downward break to fizzle out, and you only buy once the price proves it's a fake out by closing back above the pattern's high. This move lets you ride the wave of all those trapped short sellers who now have to buy back their positions, which just adds fuel to the rally.
All right, our second setup is for a genuine bona fide breakout, but there's a catch. We are looking for a very specific condition, triangles that break out and push a stock into all-time highs, where there's no old resistance to slow it down.
And you can just feel the power of this setup on this chart. The triangle forms, it breaks to the upside, and then it punches right through that previous peak. Once it gets into what traders call blue sky territory, there's literally nothing holding it back, and you can see the epic run that follows. And here's another little edge the data gives us. Triangles that form after a fairly quick trend, we're talking 6 months or less, tend to have a much better performance. They average a 74% gain in these perfect scenarios. It seems that quick consolidations often lead to more explosive moves.
But of course, it's not all sunshine and new highs. More often than not, a stock breaks out and runs smack into a brick wall of sellers at a previous price peak. This is an incredibly common scenario, and it's a huge reason why these trades fail.
And this chart, man, this is a classic example of that exact danger. The stock breaks out, looks great for a day, maybe 2, but then it hits that ceiling from the previous high. It stalls, it reverses, and the trade turns into a loser. The key, the absolute key, is identifying that resistance level before you ever put your money on the line.
Okay, we have covered a ton of ground. We've gone from spotting the pattern to understanding its tricky statistics, all the way to concrete trading plans. So let's boil all of this down into a simple, powerful toolkit that you can actually use. And finally, let's talk about where to get out if you're wrong. Risk management. The data on this is unbelievably clear. If you're trading an upward breakout, put your stop loss just 1 penny below the lowest low of the entire triangle. The chance of that stop getting hit, just 5%. That one simple rule can save you from getting shaken out by all those common throwbacks we talked about.
So in the end, the pattern itself isn't good or bad. It's just a pause in the action. The difference between it being a trap that takes your money or a trigger that starts a profitable trade, well, that comes down to knowing the stats behind it and having a plan. The data is your map. Now you just have to decide where you're going to go.
You know that feeling, right? You're watching a stock and suddenly its price just falls off a cliff. That knot forms in your stomach, it's just pure panic. But what if that chaos wasn't so random? What if it was actually a pattern, something you could recognize, with outcomes you could almost predict? Well, that's what we're going to do. We're going to take that panic and turn it into a plan. I mean, this is the question, isn't it? Every single person who's ever invested has asked this. You just see all that red on your screen, it's getting bigger and bigger, and you have to make a call. Is this a catastrophe for this company, or is it something else entirely? And this is what that feeling looks like on a chart. Just look at that drop. There's basically no hesitation, is there? It's just a straight shot down. It looks scary, I know. It's actually designed to trigger that fear response in your brain. But we're going to learn how to look at this with a totally cool head.
That's the first step. This isn't just some random market freakout. You know, technical analysts have been studying this exact thing for years, and they've given it a name. And as soon as you can name something, you can start to understand it. There's this fantastic quote that just perfectly captures the force we're talking about. Price plunges like a barrel over Niagara Falls. Think about that. It's not a gentle little stream. It's a massive, powerful waterfall. And just like a real waterfall, it has a start, a middle, and, most importantly, an end. So how do we get past that gut reaction and into actual analysis? Well, we need to know exactly what we're looking for. Let's become detectives for a minute and break down the anatomy of this free fall so you can spot it out in the wild. Okay, so here's the official name for it. It's called a vertical rundown. The keywords here are swift and steep, for sure. But also, notice there's very little bounce from day to day. It's like each day just opens lower and closes even lower. But here's the interesting part. The median duration is just 7 days. It's incredibly violent, but it's usually over pretty quickly.
Think of this as your checklist, your field guide. First, you need that steep drop for at least 4 days, or 4 bars on your chart. Second, the price from one day to the next, it doesn't really overlap much. It just keeps falling. Third, sometimes you'll see these little pauses, they're called flags, but you don't always see them. And finally, number 4, the pattern is only over once that crazy steep slope finally breaks and the direction starts to change. Those are your key ingredients. All right, now we get to the really juicy part. Once you've spotted a vertical rundown, what does all the historical data tell us is most likely to happen next? Because this, my friends, is where that feeling of panic really starts to morph into a feeling of opportunity. And here it is. This is probably the single most powerful statistic in this whole analysis. After the vertical run finally ends, the price bounces back up 84% of the time. Just let that sink in for a second. What looks like an absolute unmitigated disaster is followed by a recovery more than 4 out of 5 times. Only about 16% of the time does the stock just keep on drifting lower. But how strong is that bounce really? Is it just a tiny little blip? Nope. The median recovery is 81%. That means that half the time, the stock actually recovers more than 81% of the value it just lost in that terrifying plunge. So we're not talking about a little dead cat bounce here. This is a serious, significant recovery. And get this, in almost half of all cases, 46% to be exact, the stock makes a full recovery. It climbs all the way back to the price where the whole nosedive started. It's like all that panic selling gets completely and totally erased from the chart. Okay, that's great. So we know a bounce is really likely. But can we get any hints during the free fall about when it might actually end? The answer, thankfully, is yes. Even right in the middle of all that chaos, the chart is sending out signals if you just know how to read them. So let's focus on 2 of the biggest signals, price gaps and these unusually tall price bars. You see, gaps show this sudden, usually overnight, shift in what people are thinking. And tall bars, they show a day of just extreme, intense selling pressure. Both of these are often signs that the panic is about to burn itself out. Now, here's the tricky part. Not all gaps mean the same thing. About 3/4 of the time, you'll see what's called a continuation gap. It shows up in the middle of the drop, and, you guessed it, it signals more downside to come. But that other 25% of the time, you get an exhaustion gap, and it happens right at the end. That's like the last gasp of the sellers, and it often means the drop is finally over. So what about those big, tall bars? Well, it turns out that the single tallest day of selling, the biggest drop in one day, very often happens right near the end of the whole run. More than 1/4 of the time, it happens in the final 10% of the entire move down. This is what we call capitulation. It's the moment where the very last of the panic sellers just throws in the towel and gives up. When you see that, you know the bottom is likely very, very close. Okay, so we can identify the pattern, we know the most likely outcome, and we can even spot some clues that the end is near. Now, let's put all those pieces together and see how this knowledge can be built into a real, actionable plan for different kinds of traders. First up, if you're a long-term investor and this happens to a stock you already own, the data really suggests you should probably just hold on tight. I mean, with a nearly 50-50 shot at a full recovery, selling into that panic is very often the worst thing you can do. And for position traders, the odds are also on your side. Only about 20% of the time does this kind of pattern lead to a major long-term downtrend.
But what if you don't own the stock? What if you're an active trader and you're actually looking for an opportunity? Well, that moment of maximum fear, the very end of the vertical run, can be a calculated, strategic entry point. But, and this is a big but, you have to be precise about it.
Here's a really simple but super effective tactic. Once the stock makes its lowest point, that's the bar labeled E here, you don't just jump in right away. You wait. You place a buy order just a tiny bit above the high of that last low bar. Why? Because this forces the stock to prove to you that it's actually stopped going down and has started to reverse, even if it's just by a little bit.
All right, so you've used a smart entry to get into the trade right as the price is turning. Now comes the most important question for any trader. Where do you get out? You have to have a logical, data-driven target in mind.
And guess what? The data gives us a fantastic answer for a high probability target. 64% of the time, that's almost 2/3 of the time, the stock will climb at least halfway back up the vertical run. So you're not getting greedy, you're not trying to catch the whole move all the way back to the top, you're just aiming for that halfway point, which the stock is statistically very likely to hit.
And right here, you can see the entire strategy in action. The run ends, you enter just above that last low bar, you set your sell target at that halfway point. In this real-world example, that simple, straightforward plan led to a gain of almost 12% in less than 2 weeks. No panic, just a plan.
So if there's one thing to take away from all this, it's that what looks and feels like pure, unadulterated chaos on a chart is actually often a recognizable pattern. It has a typical structure, and it has statistically predictable outcomes. And by learning to see that structure, you can stop reacting with emotion and start acting with a strategy. You know, we started by asking how worried you should be when a stock just plunges, but maybe, just maybe, that was the wrong question all along. After looking at the data, the better question might be this. When everyone else is running for the hills, is this steep, terrifying drop actually the opportunity you've been waiting for? Have you ever owned a stock that just, well, it takes off? It feels like you've strapped yourself to a rocket. It's exhilarating, it's profitable, but you know what? It's also kind of terrifying. That pattern has a name. It's called a vertical run-up. And knowing how to handle it is one of the most critical skills a trader can have. So let's deconstruct this thing. So picture this. You're watching the screen, and your position is just climbing, day after day, almost straight up. The profits are piling up so fast you can barely keep track. It feels absolutely incredible. But in the back of your mind, there's that little voice, and it's whispering, this can't possibly last. And that really is the million-dollar question, isn't it? Do you sell and just take the money? Do you hold on hoping it goes even higher? What you decide to do in that moment can be the difference between a legendary trade and a painful lesson. This right here is all about giving you a data-driven plan for that exact moment. Okay, take a look at this chart. We are laser-focused on that incredibly powerful, fast climb from point A to point B. That, my friends, is a classic vertical run. It's almost literally a straight line up that covers a ton of ground in no time at all. And that sharp drop right after, well, that highlights the danger. What goes up this fast often comes down just as dramatically. So step one is being absolutely sure you're actually in one. So let's get into the anatomy of this pattern. Being able to accurately identify a vertical run is the foundation of everything that comes next. This isn't just any old strong uptrend. It has very specific telltale characteristics we need to look for. Okay, so here's the official definition, and it's got 3 key parts. First, the move has to be near vertical. Second, it has to last for at least 4 consecutive price bars. So on a daily chart, we're talking 4 straight days of this insane action. And third, and this one is super important, there should be minimal price overlap from one bar to the next. Let's dig into that overlap part right now. This table really makes it clear. You see the 4-bar minimum we just talked about, but look closely at overlap. The data shows that the median overlap is just 31%. What that really means is that each day's price action is gapping up or starting significantly higher than the last. The buying pressure is just so intense that there's very little shared price territory from one day to the next. And when does the run end? The moment that vertical movement stalls, it's over. And this quote from Thomas Bulkowski, whose research this is all based on, just nails it. The intent,
is to emphasize that price should be moving up swiftly, not meandering higher. We are looking for speed, for a direct, almost violent move to the upside, not a stock that's just kind of drifting its way up.
All right, pop quiz time. Look closely at these two charts. You've got the move from A to B and the move from C to D. Now, both are really strong climbs for sure, but based on our rules, 4 bars, minimal overlap, swift movement, which one is the true vertical run? I'll give you a second to decide.
If you said A to B, you nailed it. And this is such a great illustration of the difference. The move from A to B is swift, it's direct, and it has very little overlap, in this case, only 19%. Now look at C to D. Yeah, it's strong, but it's slower, it has way too much overlap between the daily bars, and it kind of meanders its way up. It's a great trend, don't get me wrong, but it is not a vertical run.
Okay, so now we know how to spot one, which brings us to the most important part. What happens next? And this isn't about gut feelings or what you think should happen. This is about cold, hard, statistical probability based on a massive study of these patterns. So let's see what the numbers say. And here it is, the most important number of all. Once a vertical run ends, 79% of the time, let me say that again, 79%, the stock immediately starts to fall and retrace its gains. That is a nearly 4 out of 5 chance of a pullback. Only about 21% of the time does the stock keep going higher, and even then, it's at a much, much slower pace.
So how big is that pullback? Well, the median retrace is 53%. Just let that sink in for a second. That means in half of all cases, the stock gives back more than half of the profit you just made during that incredible rocket ship ride.
And here's where it gets really dangerous. A full 25% of the time, that's 1 in every 4 of these things, the price retraces the entire gain. It goes all the way back down to where the vertical run first started. This is exactly why trading these patterns without a plan can be absolutely devastating.
And just to give you a feel for the timeline here, these runs are incredibly short. We're talking 5 to 8 trading days typically. That's it. And if you do decide to hold on through that very likely pullback, the data shows it takes a median of 18 days just to get back to the high you saw at the top of the run. Okay, the odds are clearly stacked against you. The data doesn't lie, but that does not mean we're helpless. It means we need a playbook. And how you should react depends entirely on your personal trading style.
You know, there are really 2 camps here. If you are a long-term investor, the data suggests you can probably just hold on. Get this, a stunning 94% of these stocks go on to make a brand new high within 3 months. But if you're a short-term trader, your goal is totally different. You need a disciplined, no-nonsense exit plan to lock in those gains before that almost inevitable retrace kicks in.
And for you, short-term traders, there is a specific mechanical rule that has proven to be incredibly effective. It's called the high watermark rule, and it's designed to take all the emotion, all the fear, all the greed right out of your sell decision. So here's how it works, step by step. First, you find your valid run of at least 4 bars. Then, you identify the bar with the highest peak. That bar is now your high watermark. From that moment on, you watch every single bar that forms. If any bar closes below the low of your high watermark bar, boom, that's your sell signal. You get out at the market open the very next day. Simple as that. And what if the stock makes a new, higher high instead? You just reset. That new bar becomes your new high watermark, and the clock starts again. Let's walk through this chart example to make it totally clear. You can see the first high watermark is set at bar B, but then the stock pushes to a new high at C, so C becomes our new high watermark. Then it happens again at bar D. That's our new and final high watermark. Now look closely at what happens at bar E. See how it closes below the low of bar D? That's the trigger. You sell at the open of the next bar, F, locking in the vast majority of your profit right before the stock completely falls apart.
And how well does this rule actually work? Well, in a bull market, after this rule triggers a sell signal, the stock continues to drop lower 96% of the time. That is an incredibly reliable data-backed tool for protecting your hard-won profits.
So, what's the big takeaway here? What's the bottom line? It's about taking one of the most emotional, most chaotic moments in all of trading and applying a calm, logical, data-driven framework to it. It's about turning that potential chaos into a clear opportunity. So here's your final checklist. 1. Remember that vertical runs are powerful, but they are always temporary. 2. The data is clear. A pullback isn't just possible, it's highly probable, a 79% chance. 3. Your strategy depends on your time frame. Long-term investors can probably ride it out, but short-term traders absolutely need an exit plan, and the high watermark rule is that plan. And finally, the most important point of all, have this plan ready before you find yourself on that rocket ship.
And that leaves us with a really fascinating thought to chew on. We've just seen that what looks like pure market insanity, a stock just going vertical, actually has very predictable odds and behaviors hidden just beneath the surface. It really makes you wonder, doesn't it? What other parts of the market that seem to be driven by pure, raw fear and greed might also have these hidden statistical patterns, just waiting for us to discover them?